on the eve of an election. It certainly doesn't look good, but that's not going to stop them from doing a 50 basis point move or even 75 basis point move if the labor market did seem to deteriorate quickly.
Okay, we're going to have to leave it there. Thanks to Anna Wong, Chief U.S. Economist for Bloomberg Economics. Check out her research, the entire team's research. You can do that on the Bloomberg terminal. Now to more on what traders, investors, and yes, politicians are thinking regarding the Fed's next move, because with inflation seemingly under control and weakness showing in the U.S. labor market, as we've been talking about, officials widely expected to drop their benchmark lending rate by at least a quarter percentage point when they wrap up that two-day gathering on Wednesday. Traders, plus economists at JP Morgan and former New York Fed President William Dudley are even preparing for a larger half-point move.
The market has come to the view that 50 basis points at this meeting is, in fact, appropriate. It's pretty important that the Fed head back to neutral expeditiously, and that 25 basis points wasn't fast enough.
That's Bill Dudley, also a columnist for Bloomberg Opinion and a Bloomberg Economics senior advisor, former New York Fed president as well. In today's Big Take, Liz McCormick and Janelle Marte write about the Bloomberg News, for Bloomberg News, how investors are more focused on what will happen immediately after the Fed's announcement. Check out Liz's story and more from Bloomberg, the Big Take on the Bloomberg terminal and at bloomberg.com/Big Take. We got Liz McCormick with us. She's Bloomberg News chief correspondent for global macro markets, joining us from New Jersey. Liz, traders and economists can't even agree on whether this week's announcement will or should be 50 basis points, 25 basis points. You have politicians, lawmakers coming out and saying it should be 75 basis points. Why is the path ahead, what comes after Wednesday, so uncertain?
Boy, when have we seen, and I've been around longer than you, I won't say when, Jim, there's so much uncertainty. And I think I was listening to Anna Wong, who I have a lot of respect for, that, you know, maybe the Fed wanted to gin up these rate cut bets to, you know, over 50, but it's still not a great look, you know, because 50-50, basically a coin flip, a little bit over 50. I don't think, you know, we don't usually go into a Fed meeting with this much lack of clarity in the market, right? The Fed likes, you know, no uncertainty. So usually it's a little closer to, you know, above 50% or way below. So I don't know, whatever the case, we'll do an autopsy afterwards. But, you know, I just talked to an asset manager who said to me, like, after all this, you know, he thought also the Fed kind of lifted these probs in the market that if the Fed doesn't do 50, it just looks really bad. But who knows, Tim? We just don't know. Like you said, many of the big economists still say 25 basis points. That's still more the consensus. So I think, like you're saying, what goes on from there? Crucial is the dot plot, right? So either way, we could do the scenario analysis. If they do 25, what do the dots do? And if they do 50, what does the dots do? So we have 2 more meetings this year. We want to see, given whatever they do on Wednesday, what's the consensus that they're going to project for the next 2 meetings? Is it look like, is it build in at least 1 more 50, 2 more, none? What's the array of dots show? Like, how strong a majority is it to get to that median? And look at next year. They projected last time, these numbers are all going to move around, but 100 basis points next year. Do they bring in more for next year as well? And the market's already pricing that in a year's time, we're below 3%. The funds rate is, you know, decently over 5, you know, their range. So there is just a lot to decipher. I am sure, like, there's going to be so many questions to Powell, no matter what they do for clarity. So there's a lot to unpack for the bond markets, for sure.
When you think about Powell's presser and just how closely investors are going to be parsing through his words, how is he going to be able to kind of convince the market that we're still headed towards that soft landing, that he's, you know, easing up on policy, but not too much because it's signaling that there is some weakness in the economy that perhaps people are missing?
Right, exactly. I mean, that is the key. I was looking at the Bloomberg pages, our indices that, you know, bond indices, the U.S. Ag is up about 5% this year so far. So all these bond markets doing well and the stock market's still doing well. I know we're seeing a rotation, but there's a lot, Emily, like you're saying, based on this, that they pull off this, you know, ephemeral soft landing. So I think, yeah, he's got 2 things to say. If they do 50, he's got to make clear that they just, they're not panicked. They're not really worried still about the labor market, but they felt like inflation's in line, that policy was too restrictive. It was, smart to front load. Or if they do 25, he's got to explain why that's enough and that they're willing to go big if they need to. Again, the Fed has made clear they really don't want to crush the labor market, and they want that soft landing. So I think in any case of what they do, Chairman Powell's he's going to have a lot of notes, like he usually reads from his notes, and try to stick to the script to try to explain why they're willing to go bigger if they go small this time, or why, like Emily, you got to, it's not a panic, and someone said to me, maybe, that's why these stories were in the press last week, that they want that pricing in there at least so it doesn't totally surprise.
Okay. Liz, you make a point in your story, The Big Take today, that you and Janelle wrote together, that there's still some folks out there who think there's a chance that inflation could accelerate again, could rear its ugly head. We haven't been talking about that much in the context of what the Fed will do this week. Who thinks that and why?
Well, I mean, let's say Priya Misra, she's not saying inflation. She's at JP Morgan Asset Management is going to rear up, but she said maybe they're going to go a little more gingerly if they're concerned. As everyone has brought up, many of your guests, of course, the Fed got the inflation wrong on the way up, right? They thought it would be transitory, and they had to kind of step up the pace of hiking. They smartly held off moving as far as cutting a few times. They wanted to wait, and then we saw earlier this year, at the start of the year, inflation picked up. So there's some saying, that there is risk. I think, Tim, the bigger risk people see that inflation could pick up is if, financial conditions, which, stock prices, bond yields, that's all factored in there, financial conditions kind of really ease even more, like too far, then maybe that stokes inflation. If we're all more positive and go spend more, then maybe inflation picks up. And the Fed is like a fine line. They're trying to kind of give the American consumer a break, bring yields down so people can get mortgages at better rates. But they don't want to kind of get excitement, exuberance too much. And then there is a risk that people all start spending and we get a little inflation. So it's definitely a tough road to walk for them.
Liz, you mentioned Priya Misra. She's going to be joining Carol out there at Future Proof in California a little later in the program. So looking forward to that conversation, Emily.
So, Liz, we don't have a ton of time left, but I have to ask about the expectations for, what the market is going to do on Wednesday. We have the 2-year right now, 3.5, 10-year, 3.6. What are your sources kind of telling you? What are they buying right now to kind of prepare for the potential volatility on Wednesday?
Well, a lot of people are looking in two sides of the coin. Aside from the steepener trade, they have the views on the short end and views on the long end. And the long end folks, another asset manager said to me, he thinks, 10-year yield's going to be in a broad range, maybe only as low as 3.25, could flirt up to 4%. Because remember, when we get through this Fed meeting, there's a lot of stuff ahead, right? The election, what's the fiscal policy outlook look like? Again, the lingering risk, Tim said, some are seeing that maybe inflation picks up. So there's less people favorable on the long end besides those looking to buy it as a hedge that the world, kind of the economy falls apart. So I think that I think you're going to see it more in the short end if the Fed, especially if they go 50, you're going to see rates go down even further, more steepening of the yield curve.
All right, 2 p.m. on a Wednesday. Our eyes, our ears, everything will be glued to what Fed Chair Jay Powell has to say in the statement and, of course, at that press conference. We'll bring you all of that live here on Bloomberg Radio and Television. A big thank you to Liz McCormick, Bloomberg News, Chief Correspondent for Global Macro Markets. Check out her story and more from Bloomberg The Big Take on the Bloomberg Terminal and at Bloomberg.com/Big Take. Markets, well, the S&P 500 up fractionally right now. The NASDAQ is still lower with big tech taking a hit. Up next, we're talking energy because new gas plants just keep on coming. That's next on Business Week.
Wall Street. We do check markets all day long here at Bloomberg. We are looking at a mixed market right now. Bets for a half-point hike are growing. Stocks, little changed. At least the S&P right now, higher by 3 to 56.28, up less than 0.1%. Have been lower for much of the morning. We've got the Dow up 187 now, up by about 0.5%. Nasdaq, though, in the red. Tech selling off. We got Nasdaq down 0.6%. The Nasdaq 100 index, full of big tech names, down 0.5%, while the Russell 2000 index of small cap shares up by about 0.3%. 10-year at 3.62%, with the 2-year now yielding 3.55%. Spot gold up $3 the ounce to $25.80, up 0.1%. And West Texas Intermediate crude oil up 2.1%, $70.11 for a barrel of WTI. Amazon shares down 0.8%. Amazon CEO Andy Jassy is ordering the e-commerce company's employees to return to working in the office 5 days a week beginning in January. He also says the company will be seeking to reduce management layers. Again, recapping stocks trading mixed. S&P up 3, up by just under 0.1%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
Hey, thanks so much for that update, Charlie. Certainly do appreciate it. Well, energy companies in the U.S. are planning new natural gas-fired power generation at the fastest pace in years. It's one of the clearest signals yet that fossil fuels are likely to have a longer runway than it previously thought. From Florida to Oregon, utilities are racing to meet a surge in demand from power-hungry AI data centers, manufacturing facilities, and yes, even EVs. So it looks like the prolonged reign of natural gas will bring major environmental consequences. We got with us Josh Saul. He's Bloomberg News energy and climate disasters reporter. He's part of the team writing about how AI's massive power demand is driving a renaissance for, yes, gas. Josh joins us here in the Bloomberg Business Week studio. A quick note, Michael Bloomberg, the majority owner of Bloomberg News parent Bloomberg LP, has contributed to campaigns to close coal-fired power plants and transition from fossil fuels. Josh, the anticipated energy demand, you've written about this for months at this point, it's pretty staggering. The staying power of gas, what exactly is going on? Because it was not so long ago that experts were like, okay, well, we've kind of hit peak gas demand here in the U.S.
It's really caused whiplash among energy experts. I joined this energy team in 2021, and at that point it was sort of, oh, okay, well, we can stop building a lot of new gas, and even some gas plants can start to be retired in order to get those carbon reductions that a lot of these companies are aiming for. But there's been so much energy demand. AI basically came along and ate my beat, and the energy demand is such that now these same companies are saying we're not only not going to retire any gas power plants, we're actually going to build a lot more.
Good job security for you, I guess.
Lots to write about, for sure.
So what about solar, wind, and other renewables? What about gas is, connecting it to this surge in AI that these other forms of renewables can't compete?
The issue is that solar and wind are intermittent, which is our fancy word on the energy team for they're not on all the time. And a gas plant, while it can shut off in bad weather, can shut off when it's prepared, it has baseline power, so it's producing its energy 24 hours a day, seven days a week. And energy companies really like that. And data centers are also 24/7. There's people around the world plugging things into ChatGPT, running medical tests, doing all of the things that they do with AI all the time. So those data centers are also on all the time, and that's what makes gas so attractive.
There are some silver linings here in the sense that gas is cleaner than coal, right?
Gas is cleaner than coal. Like, I'd rather live next to a gas plant than a coal plant, but the carbon emissions of coal are greater. But the thing with gas, when you have a lot of gas infrastructure, the gas leaks out.
This is the methane problem, right?
Yeah, I mean, natural gas, which is kind of a funny word, but the gas is almost entirely methane. And when that leaks out anywhere, it has actually much more climate changing power or planet warming power than carbon. Some of our coverage over the past couple of years is basically that none of these companies really know how much gas is leaking out of their operations. You have pipelines that are hundreds of miles long. You have power plants burning the stuff. So the climate benefits of gas get a little muddy when you actually get into the entire gas stream.
So talk about what your reporting has shown about just the numbers here. about how the industry is adapting, how many new plants are being built.
The thing that was exciting about this story is that we got into the data. We had some different organizations that have collected really good data on this. So first, the Sierra Club, their data shows that that just in the first 6 months of this year, there's more new gas planned than in all of 2020. And if it continues, on track through the rest of this year, it'll be a record from when they started keeping this data in 2017. So power companies, energy companies are just planning a lot more new gas than they have in the past.
I think one thing that's particularly concerning about your piece is the staying power of these plants. Mm-hmm. You write that the lifespan of one of these plants tends to be about 40 years after it's built. Does that necessarily mean that they're going to be running 40 years from now if they get built? And we'll talk about that in a second.
It's pretty expensive to shut down plants early. I mean, these things are extremely expensive to build, and the whole idea is that when you build them, you amortize the cost of them over a long period of time. Consumers are already going crazy and getting angry over their rates, over the cost of their power bill. So if you build a lot of really expensive infrastructure and only run it for 10 years or only run it for 20 years and then shut it down, that's going to cause even bigger spikes in customer bills, which will cause even more rate rage of the kind we've been seeing. So, I mean, I don't have a crystal ball, but yeah, I mean, it seems like once you build something like this, usually it sticks around for a long time.
We know that, or what we can likely predict, that the demand for AI is only going to keep going up. And so we're going to need even more energy to power. Do we know yet whether the production is actually going to be able to keep up with that demand?
It does seem like, from the utilities I talked to, that they are able to, not always as fast as the tech companies want, but once they build some more power lines, once they build some more generation, they have been able to hook up most of the big data center and the big data center campuses on some kind of timeline that's attractive to the tech companies.
You mentioned EVs in your reporting. It's not just about AI demand. But,
right. So
But how big of a demand on the grid or on power are EVs, and are they anticipated to be?
The EVs are smaller. So what I would say is when we talk to big power companies, when we have the CEOs in here at Bloomberg, they talk about first data centers driven by AI. Then they talk about new manufacturing, part of Biden's onshoring with everything from chips to actually building EVs, but just any big factory is also going to use a huge amount of power.
And we're going to be talking about trains in just a minute with regard to this. So
I can assume that takes a lot of power to build a train. And then right over into EVs, which are in the bucket of overall electrification. So that's just kind of everything is turning to electricity. So home heating, transportation.
Right, getting rid of that gas-powered heat.
Exactly.
Going to these heat pumps.
Any of that is just going to drive overall electricity demand, which is going to mean more demand for either solar or wind in transmission, or for more gas, for SMRs, for nuclear, for any of these things that people are really into.
And this is in stark contrast to what we've seen over the last few years, which has been relatively stable in terms of demand, not growing at the rates that people think it's going to grow at over the coming years.
That's exactly right. So for most of definitely my whole time on this team, and even going back decades, electricity demand has been pretty flat. It's been a kind of a sort of a sleepy industry. What's happening now is that energy demand is booming so much, is booming so much that it's just completely changed all of that, and now shares of the companies that produce these are booming in ways that they haven't before. Just lots of different that's trickling down to all kinds of places.
So how does that affect the path of carbon emissions that now we have more demand?
Yeah, it means more carbon, and it means a lot of these climate goals are getting revised or not quite torn up yet in most cases, but you definitely you'll be at a power conference, or you'll be at a utility conference, and you'll have energy utility CEOs talking about how the AI power demand or the overall power demand is complicating their climate goals. They're sort of starting to front run a little bit that some of their goals, the most common one is a 2050 net zero goal. So that'd be by 2050, they're going to have net zero carbon emissions. That's kind of the big one that's far off for a lot of these companies. They're sort of starting to talk about how these goals are becoming more complicated or more challenging.
The nuclear power industry has entered the chat, Josh, because they would like to take an increasing share of this. A lot of challenges, though, as you've reported, when it comes to nuclear. Speaking of infrastructure.
Bros love talking about nuclear. And I would say that it's really, really hard to build a big new nuclear plant.
I mean, look at
It
Georgia.
hasn't happened a long time. The Georgia plant was tens of billions of dollars over budget, something like a decade and a half, something like a decade, behind schedule. No other company, even the company that built that one, Southern, is taking on a new nuclear power plant. So people really like to talk about them, but there are no new big nuclear plants on the drawing board right now in the U.S.
What about for the gas plants? Where are those actually being built? And you write about announced plans, but does plan actually mean action?
Yep, right, sure. Well, there will always be some planned infrastructure that falls off the wayside. The developers pare back their plans or something like that. But we have seen, in the past that plans, some proportion of plans end up actually getting built. So way more plans will mean, presumably, in the years to come, lots more gas plants. As far as locations in the U.S., the Southeast is a real hot zone for new gas plants, and then in Texas they love gas. They even started a new energy fund there to have billions of dollars of state funds going towards the development of new gas plants.
You mentioned consumer prices when it comes to what they've thought about their electric bills in recent years, as we've seen prices, as we've seen usage gone up, I should say. What does this all mean for energy bills?
It's always a little tricky, but the bottom line is building new infrastructure costs money, and some piece of that, some proportion of that, is then tacked on to consumer bills. So big demand by commercial users, by data centers, by tech companies. Some proportion of all that new transmission, all that new generation gets filtered down and makes power more expensive for everyone.
Just very briefly, is there a chance that this stuff gets more efficient in the next few years and demand won't go up as much as anticipated?
It's possible.
Okay. Possible, but
it's possible.
It's
but
not even part of the conversation right
the
now.
data centers that I've been inside, there's so much demand.
Yeah.
The data center operators are just like, as soon as we get the power, we just fill it up with servers. We just run and more. When it gets more efficient, we just put more servers in here. All our customers want is more computing power. So, I mean, I guess it could get more efficient, but from what I've seen, when it gets more efficient, they just put more servers in there and run more compute through it. So, no, I think to me, it continues to use more power.
All right, our big thank you to Bloomberg News energy and climate disasters reporter Josh Saul joining us here in the Bloomberg studio. Redhead crossing the Bloomberg terminal just in the last few minutes. Vista Equity Partners and Blackstone are discussing an offer of around $56 per share for Smartsheet. This is according to a Reuters report. They cited unidentified people familiar with the matter. The deal could be signed in the coming weeks, assuming there are no last-minute snags. Vista and Smartsheet did not immediately respond to requests for comment from Reuters. Blackstone declined to comment to the media outlet. Well, coming up next, we mentioned we're going to be talking about trains. How does a 200-mile-per-hour high-speed rail line that connects Vegas to Southern California, how does that sound? Probably pretty good. Well, it's at risk thanks to a corporate rivalry. We'll talk a little bit about train manufacturing after this. This is Bloomberg.
2:40 on Wall Street. We do check markets all day long here at Bloomberg. We have got the Dow, the S&P, both higher. NASDAQ 100 index in the red. Right now, the S&P's up 3, little changed, up just under 0.1%. Dow Industrials up 204 points now at 41,597, up by 0.5%. NASDAQ, though, selling off, down 101 points, down by 0.6%. Traders gearing up for this week's Federal Reserve decision, kept driving a rotation out of the tech mega caps that have powered the bull market in stocks. 10-year at 3.62%, with the 2-year now at 3.55%. Gold up $3.50 the ounce to $25.81, up by about 0.1%. Crude moving higher by 2.2%. West Texas Intermediate crude back above $70 a barrel now at $70.15. Bausch & Lomb shares are higher after a report that the eye care company is considering selling itself to disentangle from its debt-laden parent company. Bausch & Lomb shares, they're up now by 15%. Again, recapping, little change for the S&P 500 index, higher, barely, up now by 1 point. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Hey, thanks for that update, Charlie Pellet. Well, for nearly 20 years, a plan has been brewing for a high-speed rail line connecting Las Vegas and Southern California. Something was always getting in the way. Ballooning budgets, bureaucratic red tape, developer and investor switcheroos. Now those shovels are finally in the ground on the $12 billion Brightline West project, yet there's one more wrinkle. It's a corporate rivalry between two manufacturing giants vying to build the highly specialized trains that will reach speeds of 200 miles an hour, or more than 200, the fastest in the U.S. Ted Mann and Brooke Sutherland of Bloomberg News write about all of the drama. Ted is Bloomberg News money and influence reporter. He joins us from our Washington, D.C. bureau. Ted, we love talking manufacturing and trains in California. We're going to get to the drama in just a minute, but tell us a little bit about what's at stake here, because this is a story that's not just about trains connecting two cities. It's about the Biden administration and the federal government. It's about the Olympics, and it's about, quote, buying American and what that means.
Yeah, that's right. The Biden administration, as part of the bipartisan infrastructure law and the funding that it provided, have been trying to find some demonstration projects for real high-speed rail. There really isn't in the United States yet. That means trains going 200 miles an hour. And this project, which was already being planned, is one of the areas where the federal government has seeded some investment, where you have a private operator who wants to get it up and running, where they have a target, pretty ambitious, of getting it running by 2028 in time for the Olympics. And so all of this is exactly what the administration was looking for. Basically a proof of concept to get real high-speed rail going in the United States for the first time.
Okay, Tim, can we get to the drama now?
Yeah, let's get to the drama.
Yeah.
Okay, so...
Well, someone's got to build the trains. And there are really two entities that applied to try to win the business. Siemens, which is based in Germany, obviously, and Alstom, the French company. They both have outposts in the United States because they make and overhaul trains for commuter services and subway lines. Neither one of them is building a true high-speed train in the United States yet. Brightline ultimately selected Siemens, and it has said that they're going to move forward and have Siemens build 10 brand new high-speed trains. Alstom has sued the federal government, basically trying to block the waiver of the Buy America rules, which restrict whether you can use federal money to pay for something that wasn't made and assembled in the United States. So Alstom is basically saying Brightline should have gone with them because they're closer to having a high-speed train that could be produced and run on these tracks between California and Vegas.
Okay, so what happens next year that we have these two feuding companies? If Siemens is already going to be manufacturing these trains, is there a chance now that the other company kind of comes in and, excuse the pun, but derails that production?
It's kind of hard to avoid the derailing puns here. Alstom is certainly hoping that they can do that. Siemens is plowing ahead. They've announced that they're going to put a factory in New York. They've extended a sort of olive branch to labor to organize that factory. That was part of their pitch, really, to make themselves an attractive option here. But yeah, Siemens is going to move ahead and just try to continue with the designing and building of these trains. right now, there's an ongoing court fight because of the Alstom suit, and Siemens and Brightline have joined that lawsuit to try to argue against this move by Alstom. But at least for now, the project appears to be moving forward. If Alstom is successful, it really is unclear what this would do to Brightline's schedule, and certainly it would be likely that the timetable of 2028 would slip.
Why are train cars meant for California being built 2,500 to 3,000 miles away in perhaps Horsehead, New York?
Certainly one of the things that everyone was watching as the law was passed and then as the funding has been doled out is whether these facilities would go to states that have strong political connections. The Senate Majority Leader, Chuck Schumer, is a big longtime booster of Alstom because they have a factory in Hornell, New York. He was there to celebrate Siemens' plans to open one in Horseheads, New York. Siemens has also said that there were site advantages to this place in New York State that they've selected. That it would be easier to get a factory up and running quickly to make these trains and deliver them according to the Brightline timetable. But it's certainly the political considerations and the considerations of doing this work, at peace with the unions involved. All of those were in the mix.
If all goes well, what should Americans actually expect the experience on the Brightline West to be like on a high-speed train? I know a lot of Americans actually might not be familiar with what that is like because we don't have a lot of those.
I mean, really what they're aiming for is the state-of-the-art that has existed for a long time in Europe and Asia. And that would be a train going, the Siemens model, they say, will be able to hit 220 miles per hour, which is far faster than the Acela goes, even in short stretches here on the East Coast, and is unheard of anywhere else in the U.S. The goal would be for it to be a significant service on par with what you would get riding the trains in Western Europe and all over in Japan and China.
It gets you to Las Vegas, but you got to go to Rancho Cucamonga to get there.
Yeah.
Is that an issue?
That certainly is one that people have been talking about for a long time with this project. The original plans for the project had it stopping even further out in Victorville. The plan now is to connect in Rancho Cucamonga, where at least theoretically you could take a Metrolink train from Union Station in downtown LA out to Rancho Cucamonga and then get on one of these. The very long-term goal that requires a lot of bank shots is that when the California high-speed rail system eventually starts running, and when they have figured out the final ways of connecting that into downtown LA, that this system would be interoperable and that they would link up. Because of the ultimate, I think the expectation is ultimately you would want people to be able to get from the center of LA to Vegas by train. Right now it would depend on people being willing to drive or take a much slower train to get out to Rancho Cucamonga.
Ted, apologies as a Californian. I think when you said when the high-speed rail project is completed, I heard people laughing because we've been talking about this for decades at this point. Indeed. It's now a when, not an if, in your view?
Well, the segment that is under construction, they're aiming to have complete in 2030. So even the when is a long way off. And there are funding constraints and engineering constraints that still have to be solved for that system. But if you take them at face value, they say they're still working on it and that they're going to finish that train one day.
So just a quick question. Siemens is building the trains, but what's already being built right now? Is it another company building the tracks right now? Because I know in your article you said that shovels are already being deployed.
That's right. Brightline this is a brand new rail line, so they're in site design and construction on the early stages of construction on the actual physical rails themselves. So laying out that track, which is going to mostly run along a highway median out to Vegas. So the physical construction is beginning. Siemens has a little bit more time to get the train sets designed and built and up and running.
Ted Mann, Bloomberg News money and influence reporter, joining us out there in Washington, D.C. Really appreciate you taking the time. Check out Ted's story and more on the Bloomberg Terminal and at Bloomberg.com. Up next, we're going to head out to Newport Beach, California. Actually, Huntington Beach, California. That's where we find Carol Masser. We're going to get a preview of what she's got coming up over the next 2 hours, live from Future Proof. This is Bloomberg Business Week.
listening to Bloomberg Business Week with Carol Messer and Tim Stenivek on Bloomberg Radio and Television.
It is Bloomberg Business Week here in our Bloomberg studio in New York. Emily Graffeo filling in for Carol Masser because right now we find her live at the Future Proof Festival in Huntington Beach, California. It's a gathering of more than 2,200 wealth advisors. Collectively, they got more than $20 trillion in firm AUM. Carol, you got the tough job today being at the beach. How is it?
First of all, I don't know who you ticked off, Tim Stenivek, but man, you are missing quite a
Nice
treat.
shades.
The beach, it's right there. And oh, the sun is so blind. I've just got to have my sunglasses on right now. Oh, and by the way, Tim, hey, listen, here's my co-host. It's a little beach ball nonetheless. I have to say, you and I have covered so many different investment conferences. This is unlike any that I have ever done. I am in my typical attire. I've got heels on. It's shorts and flip-flops.
Yeah.
Like, that's what it is. It's very casual. You know this area, Huntington Beach. I mean, we're right, literally, beach right there. And it's tense, and it's food, and it's music, but it's all of the people that we talk to on a regular basis. JP Morgan, it's BNY Mellon, it's Invesco, and you're going to be hearing from some of those voices. And it's all about conversations, the things that we've been all talking about over the last, couple of weeks. And what a timely week, right, with the Fed meeting.
I think Dan Ives, based on the East Coast, dresses 364 days a year for this one festival out there in California, Carol, because I saw that he's out there and he is ready to be at the beach. No question.
Man, he blends in so well. I mean, it really does have a different vibe. It's a very relaxed one, and it really is about just people meeting and greeting and conversations. And it's your keynotes, it's your conversations up on stage. Yep, there's a lot of that. And some of them we're going to be featuring over the next couple of hours today and tomorrow, including Sarah Malik, Nuveen, over $1 trillion in assets under management. And she can kind of go anywhere when it comes to investments. They have a big fixed income play. But I'm curious to see what she has to say about this investment environment in a one that we think is very pivotal, if you will, because of Fed policy. We've also got the Betterment CEO on, who's going to join us, Sarah Levy. And what's interesting is you and I, Emily, I'm sure too, covers this, that we talk so much about the next generation, this great transfer of wealth, and the next generation of investing. So we're going to talk a little bit about what people are doing to attract that younger generation who think we can do it differently, and maybe don't need the traditional infrastructure that's out there.
So I got to say, Carol, it's Emily. Just like Tim, my colleagues on the cross-asset team are also at the conference, and I am here back in New York. It really does look beautiful out there.
Sorry.
But just wrapping up, what's really top of mind ahead of the Fed? Is anyone at the conference actually going to be watching the Fed decision, or are you guys all going to be at the beach?
Good question.
Well, let's think about it. So the Fed decision comes at 2 o'clock, right? So that's what, 11 a.m. this time. Yeah, listen, people will be here, and it will be certainly a discussion. But like with every Fed meeting or with every data point, I'm not saying that this isn't an important Fed meeting. We kind of get it, we digest it, and then we move on and we talk about, okay, now we're focused on this. So yes, it's part of the conversation, but so is elections. So is people constantly talking about, the longer term investment environment and some of the trends that are out there. So yeah, it's a part of the conversation, but I don't know. I'm seeing not quite cocktails yet, but it's got that feel.
Yeah, the day is young. It's barely lunchtime out there. Carol Masser live at the Future Proof Festival in Huntington Beach, California. Have a wonderful broadcast out there, Carol. The beach ball will be there, and I'll be there in spirit as a beach ball, so appreciate that. Hey, just about 20 minutes south of where Carol is right now, Huntington Beach, California, you find Newport Beach, and that's where Chipotle is headquartered. And the reason we're talking about this, Emily, is because that avocado that we've been talking about for months is finally up and running, and it's making the guac, right?
That's right. Chipotle Mexican Grill's robots that expedite avocado mashing and burrito bowl assembly are ready to serve real-life customers. And so I think in 20 seconds on average, avocado can cut, core, and peel avocados. And this, of course, is the...
Okay, today I'm going to talk about how to succeed with a startup. Obviously, more than can be said here in 20 minutes, but I will do the best I can. The most important thing the number one lesson we try to teach startups is that the degree to which you're successful approximates the degree to which you build a product that is so good, people spontaneously tell their friends about it. Startups always ask us for the secret to success. They always want to believe it's something other than this, because this is really hard to do. But this is it. If you can build a product that is so good, people spontaneously tell their friends about it, you have done 80% of the work that you need to be a really successful startup. If you think about the most successful companies you know, Google, Facebook, whatever, you probably found out about them because a friend of yours said, you got to try this, it's great. So this is the bar. Something that people love so much they tell their friends about it. One important indicator for a product like that is a product that's simple to explain and easy to understand. If you can't explain in a few words what you do, and if at least some people don't say, oh, that's pretty interesting, that's usually a mistake. It's usually a sign of unclear thinking or a need that is not big enough. Another thing that startups need to look for is a market that is either started to undergo or is soon going to undergo exponential growth. I think this is actually related to one of the biggest mistakes investors make when evaluating startups. Investors always say, well, what's your growth rate? We care about the growth rate. Investors will forgive smallish revenue today if it's growing quickly. For some reason, people don't think about markets this way. But if you think about the most important startups, they are the ones that I start in small markets that are growing very, very quickly. 11 years ago, the market for iPhone apps was $0. It's now huge. And I think if you only think about the TAM today, you'll make a big mistake. What you really want to do is identify a market that's going to grow every year and be able to ride that up elevator. A really important thing to figuring this out is learning how to differentiate between real trends and fake trends. A real trend is something that's actually going to happen and a fake trend is not, or at least not yet. And before you make a big bet on a new platform, you want to make sure it's real. Now, there's an easy trick for this, which I'll share now. Real trends are ones where a new technology platform comes along and the early adopters use it obsessively and tell their friends how much they love it. A fake trend is one where people may buy the product, but don't use it, or at least not enough. So an example of a real trend, I already mentioned the iPhone, I'll mention that again. When the iPhone first came out, many people were dismissive because they only sold 1 million or 2 million that year. And they said, well, this just doesn't matter. But for the people that had an iPhone, they used it for hours every day. It became central to their lives. They loved it. They told their friends, you got to get one. And I think it was obvious then to people paying attention that something had fundamentally shifted. And we had a new computing platform that was going to spawn huge businesses. And it was a good time to bet on mobile apps. A fake trend, or at least a fake trend as of August 2018, I would say is VR. I do believe VR will be big someday, but today most people that I know that own a VR headset use it never or very rarely. And so although a lot of people talk about it, and maybe even a lot of people buy them, there's not the intense usage per user among the early adopters that I think you want to see before you make a big bet. Another thing that startups need, at least one evangelical founder, usually the CEO. Someone at the startup has got to be the person that is going to recruit, sell the product, talk to the press, raise money. And this requires someone who can infect with enthusiasm the whole world about what the company is trying to do. And someone who becomes the chief evangelist for the company, it's very hard to succeed wildly without that. It's very hard to build a team at all without being able to do that.
Gold up 0.1%, $25.81 the ounce, and West Texas Intermediate crude oil is advancing by 2.5%. As we await a key interest rate decision from the Federal Reserve this week, traders now see policymakers more likely to cut rates by 50 basis points rather than 25. Bloomberg opinion columnist and former New York Fed President Bill Dudley writes this morning that he is expecting a 50 basis point cut, saying he believes Chair Powell favors an aggressive approach.
Doing 25 would have been awkward. Because it would have disappointed market expectations. They probably would have shown only another 50 basis points in their summary projections. So the Fed would be essentially saying we're only going to do 75 basis points this year when the market was priced for about 120. So I think doing 50 brings the Fed more in alignment with the market, and it also fits the logic of the moment.
Bloomberg opinion columnist and former New York Fed President Bill Dudley. We're keeping an eye on Apple shares, lower today, down now by 2.8%, after a closely followed analyst, Ming-Chi Kuo at TF International Securities, warned that demand for the firm's new iPhone 16 Pro model has been lower than expected. Again, Apple now down by 2.8%. For on-demand news 24 hours a day, subscribe to Bloomberg News now wherever you get your podcasts. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, Charlie, thank you so much. I'm Carol Masser, and I'm live here in Huntington Beach at Future Proof. Barry Ritholtz, by the way, is going to join us in just a few minutes. He's my co-host over the next couple of days, very involved in Future Proof, so he's going to join our discussion in just a moment. Right now, though, I want to get to the individual who's responsible for creating this just a couple of years ago and responsible for putting it on. We're talking about Matt Middleton. He's a former growth strategy director at the media publisher Informa, co-creator of the financial advisor conference WealthStack. He's the founder and CEO of Future Proof and joins us here. And I should say welcome, but thank you for inviting us.
Thank you for being here. It's amazing.
Tell us about this event in particular, because I've been to a lot of investment conferences. Everyone has its certain feel, but this is something different. And I don't know, is it just that it's outside and at the beach or something else?
It's a little bit of everything. So we created this in 2022 with the original thought being in 2020. If you recall, COVID, the events industry came to a screeching halt, right? And so at that time, most in the event space looked at it and said, well, we're going to go digital because content digital makes sense. People aren't going to travel, risk their health, leave their family. And as an industry, we're a relationship business, right? And so FaceTime is really important. So we had this idea very early on that content is important, but more importantly is the networking and the experience. And so how do you create that in a live event setting? And unfortunately, most events that are positioned inside a ballroom or a captive space don't afford you the freedom, the casual nature and tone, right? This is the first event that I've ever wore a T-shirt at in our industry, and it's fitting, right? I fit right in. And so the elements are, it's outdoor, it's casual. You have really interesting senior level people here. They're open to sharing.
Right.
And then we use technology to better connect the industry. So while this event has gotten bigger, if you come as an individual with a key objective, it's likely that that objective will be met either by the people you meet or the content you could attend through the 5 stages.
Yeah, I have to say there is something about things being more casual. I definitely overdressed, and tomorrow it'll be different. I did wear flip-flops over, but having said that, there is something about putting in a casual setting. And while I always do see meetings at investment conferences, it's just everywhere I look. It's people stopping. There's tables. Everybody's sitting down, talking. I mean, there's a lot of activity and interest. When you thought about the subjects that you wanted to cover also, I was asked by my co-anchor who's back in New York, he said, what about the Fed? Is that something, you're covering the important topics that are out there as well.
Yeah, so the majority of this audience is RIA, right? And the RIA is the fastest growing channel within the investment management ecosystem. And so these folks are here to look for how do they develop their business? How do they recruit, retain, right? They want to grow. Access to investment content, yes, it's plentiful here, but it's far-ranging here because there's more than just the investment content that they come for. They want to come for practice management. They want to come for what's happening with technology. And so focus on a very wide swath of content and therefore bring a cross-generational, cross-functional ecosystem versus just the standard investment conference or just the standard, technology conference.
Yeah, because these guys are running businesses, right? One of the guests that we're going to talk about is, legacy, like the involvement. You have got this entrenched firm, and then they've got to think about what happens after either a founder, right, or co-founder, either leaves the firm, sells the firm. You have to think about some of those issues.
They're predominantly small businesses, right? So when you think about this, many years ago when this channel started, these folks were building firms locally, and then it grew, and then they maybe acquired someone and became national. And now they're looking at it, well, I'm in my mid-50s, I'm early 60s. What's my succession plan, right? I want to leave a legacy. I have a team, right? But I also want to retire and relax and enjoy my life as well. And, it's a culmination of all of this. So you'll see at the content here, we'll have plentiful investment-focused content, but we also have estate planning. We also have, technology-focused, right? How to build your tech stack as an entrepreneur. there's over 275, vendors here. And they're not just here, handing out fact sheets like the old days, right? They're there, they're demoing, they're talking to folks. They're basically getting feedback to how to better serve this ecosystem.
How did you know that there was room for another investment conference?
I didn't know.
No, that's fair.
Honestly, it's a very crowded marketplace. I've been doing this for 15 years.
Right.
My view was, as someone who attended all these events, during COVID, I kind of said, do I really want to, go do this again? Right. Where you go to these events and you're trapped, right? And you're consuming content 12 hours a day. The only time you break away from this beautiful resort is to go get a steak dinner. And to me, that felt not organic. And so the thesis really here, and most people look at it, we call it a festival. It's bright colors. It's everything that is not traditional to our industry. But the real
it almost has a Barbie feel, hence my pink.
Yes, and my skin tone right now with the sunburn.
Exactly.
But really, when you think about it at its essence, right, the outdoor element is just a way to bring this out, which is we're all humans at the end of the day. And we want to connect people, financial professionals in our industry, at the human level, which means what, right? We want to connect people based on their hobbies, their interests, their lifestyle. We believe that as an industry, if we could find those connection points where you could make new connections or further your existing relationships in a very organic way, well, then maybe we could actually do better at getting business done naturally in our industry and further the growth of all different sectors here. And so that's why you'll see we have a music conference tomorrow. We have culinary demonstrations, right? There's
a lot of food around.
Of course, there's no shortage of food here.
It's a good thing. Having said that, what's interesting too is I think we're going to talk with the CEO of Betterment and thinking about the next generation of investing. And I just even think about the next generation of how we as financial professionals or we as media cover it, that things are changing, right? And like I said, this has got a very different feel, and the approach to what you guys is doing is very different from, I feel like, what's out there.
Yeah, absolutely.
Not to poo-poo or criticize anything that's out there, but you do see an evolution.
Well, look, what's important here is that we have a multi-generational audience, right? You have folks that are here that we were talking about succession planning. They're thinking about, all right, where's my firm going, right? How do I keep my employees engaged and involved? Or maybe, hey, I'm looking to sell my business.
Right.
And then you have the opposite spectrum, right? You have folks that are sitting here and saying, I'm just getting started. Right? I want to meet folks like Barry, right? I need to understand.
Barry Ritholtz, by the way, just walking
the crash.
So let me ask Matt
you
a
were
quick
busy
question.
introducing people up on
That's
stage.
right. I just introduced the strategists talking about what they see coming in the coming years. But Matt, your innovation, your creativity, your genius really is what led to us doing this big outdoor event. How far can we press this concept? Where are you going to go with this?
Yeah, so I think this event could scale to 10,000, right? The REA space is rapidly growing, and there's no shortage of people coming each and every year, and there's certainly no shortage of people supporting these types of events, right? So, our thesis is to have an outdoor festival type, very modern approach to conferences, and therefore serve the next generation, right? We want these events to last for the next 10 to 20 years, and therefore you need to think about who you're attracting to it, right? So the generations that we attract are at every stage, right? It's not just we want the CEOs at this stage that, in 20 years, they're not going to be in the business. And so we think about it like that. So going from this event, we announced Future Proof Citywide in March of next year, and that's going to be in Miami Beach. We have several different retreats. We're really taking this future-proof concept into an enterprise business, serving the entire wealth and asset management ecosystem.
How about the French Riviera? Where else would we like to go? Anguilla?
Greek islands.
Greek islands.
How about Bahamas?
Yeah, we're going to be in the Bahamas next October.
I'm just saying, right?
October, Bahamas.
Warm beach. I'm just planting it now. Good luck. Thank you so much.
Thank you so much.
Matt,
really appreciate it.
Yeah, thank you so much for inviting us. The founder and CEO of Future Proof, Matt Middleton. All right, you are listening and watching Bloomberg Business Week. We're going to get David Kelly up here in just a moment, but I want to turn to you. Tell me a little bit about how things are going so far.
So far, so great. I mean,
When is this your event? Too.
Yeah. So the funny story with Matt was we were talking. We had done events previously before the pandemic.
Yeah.
And 21 things were starting to open up again, and these take a year to plan an event. Hey, we'd love to do an event again. How do we not make it a super spreader event? He's like, I know. We'll do the whole thing outdoors in California.
Which is brilliant.
And it's worked out fantastically. It's so much more enjoyable and so refreshing compared to
Were you surprised at how well it has done?
There was a lot of skepticism when we first announced this, But we work with Matt and his team for years. I have a great deal of confidence in him.
Yeah.
And I figured, worst comes to worst, we'll land on our face and we'll spend a week in California. That's not the, if that's your downside.
Don't say that to
right? But it worked
No.
out great. That was 4 years ago. This is our third one.
Right.
And we're thrilled with it.
All right. Well, we're also thrilled to have next to us right now David Kelly, who's joining us. He's the Chief Global Market Strategist over at JP Morgan Asset Management, with us on site at Future Proof. Nice to have you here. You're very involved in this event.
Yeah, really excited to be here.
Well, tell me about the mood and the mood you are having right now, thinking, we've got a Fed meeting. We expect the Fed to do something, but what's the mood? It feels like everybody's feeling pretty good right now.
Well, I think that's right. I mean, it's been a very good year for markets. The S&P 500 is up 18% year to date. Bond yields are down. The economy's doing fine. I mean, it's slowing down, but it was supposed to slow down. Unemployment's low, inflation's come down. So the backdrop is good. I think the financial industry is doing very well right now, and I just think that there's a little nervousness that the Fed might somehow, panic on Wednesday and scare people.
Bill Dudley, former head of the New York Fed, thinks the Fed should be more aggressive.
I think
that they should have done it probably already.
Well, I agree that they should have started cutting earlier. Yes. But bringing interest rates down is like lowering a piano down from the fourth floor of a building. You need to do it slowly and carefully. And what I think the Fed misses is the fact that initially you cut rates, you hurt the economy.
Why is that?
Because you talk about long and variable lags. The three very bad things that happen when the Fed cuts, and this is particularly going to be the case if they cut by 50. First of all, you squeeze the interest income of all those American consumers who got money in money market funds, particularly older Americans. Second of all, if the Fed cuts 50, then the thing that's going to immediately happen is on programs like this and all over America, people go say, what are they so scared about?
Right.
They must see a recession. They're looking at all these numbers. So if I'm going to hire somebody, maybe I wait a while. If I was going to buy a car, maybe I should put that off. And so people want to wait and see. The third thing that happens, which is terrible, is you're thinking about taking out a mortgage. You're going to take out a mortgage today, you want to wait a while. I think I'll wait a while, right? I mean, if they're cutting 50, they're going to cut some more. The problem is they don't get this. I wish I could get people to understand this. There is a J-curve effect. You actually hurt the economy before you help it. Now, when rates get very low, actually stimulate the economy, but you have to wait until you get to that point. And that's what, frankly, Bill Dudley doesn't get. That's what all the people who are calling for aggressive cutting don't get. This economy is fine. Don't mess with it. Just gradually take rates down slowly. There's nothing going on over here. Don't ignore it.
Slight adjustment is
just
what you're
take
saying.
it down. It's a fine economy.
It's like when you're working on somebody's back, right? You don't just jam it in.
They're like, it's like medieval medicine. I mean, the most dangerous thing is when you're told the doctor's going to come to cure you, because they'll probably kill you. I mean, just
amputation,
lay off.
Right?
Yes, lay off.
So let's take this down a couple of months. A quarter point, half a point. It really doesn't matter. It feels like they're way behind the curve. Where do they end up? If not 50, it's certainly not going to be 50, 50, 50. Where do you see this going by the first quarter of next year?
Well, I don't think they're way behind the curve. I don't think they should have pushed rates up as high as they did. I think they should have started earlier. But let's not overestimate the importance of all this for the economy. The rates are too high because the economy is basically in a good place. And you need to gradually bring rates down to a normal level. And I think normal is probably 3.5% to 4% of the federal funds rate. You need to gradually do that. My preference would be if they, and I think they use a dot plot, and I think this is the way that they can express this. What I would love to see on Wednesday is 2 dots in 2024 and 4 dots next year. So you're going to take down 50 basis points this year and then another 100 basis points next year. I don't know if we'll see that or not, but I hope that that's what we see. But they don't need to do this aggressively. The damage they did by pushing rates up too high has already been done, but bringing it down too fast will actually make the problem worse.
Recession off the table at this point, David?
Recession is never off the table. But what I would say is we're not going to get an endogenous recession. In other words, it's not something that's built in the system right now.
Some external shock.
It's got to be an external shock. I mean, I'm looking at numbers.
So do you rule out external shocks?
No, of course we're going to, the history of the 21st century is nothing but external shocks. I mean, that's what happens.
That's true.
And eventually that'll get us. But it is important to realize that the traditional business cycle, that stress is already behind us. The point at which high interest rates cause a collapse in investments, there has been no collapse in investment spending. There's been no collapse in GDP growth either, by the way. GDP is up 3.1% year over year. In the second quarter, we think we get about 2% in the third quarter. So there's really no particular problem there.
So last question, why has so many economists got this wrong? Why are so many people expecting a recession that never seems to come?
And just got about 10, 15 seconds.
Well, I think because they listen to the mood rather than read all the numbers. You've got all the numbers imperfect, but you've got to look at all of them in order to get the right mosaic. And the mosaic looks pretty good.
All right, gonna leave it there. Great stuff. David Kelly, thank you so much. David Kelly, of course, of JP Morgan Asset Management. Folks, this is Business Week. We're at Future Proof in California. Carol Masser, Barry Ritholtz. This is
It's 3:21 on Wall Street. We do check markets all day long here at Bloomberg. We have got the Dow trading higher, S&P 500 index now unchanged on the day, while NASDAQ is in the red, down by about 0.7%. We've got the 10-year yielding 3.62%, the 2-year right now 3.56%. Spot gold up 0.1%, 25.80 the ounce, and West Texas Intermediate crude now up 2.5%, 70.37 for a barrel of WTI. Traders gearing up for this week's Fed decision kept driving a rotation out of the tech mega caps that have powered the bull market in stocks. Bloomberg opinion columnist and former Federal Reserve Bank of New York President Bill Dudley told us this morning on Bloomberg Radio the Fed should go big with a 50 basis point hike on Wednesday. Amanda Agati is Chief Investment Officer for Asset Management at PNC Bank, and on Bloomberg Television this morning she explained why she remains in the 25 basis point camp.
We really think that going 50 basis points this week sends the wrong signal that perhaps we're too late to this party, or maybe the party's ending too abruptly. And so we think 25 is the right first step. And I think we're mostly in lockstep with the consensus view that the ultimate destination is what matters. It's not one 25 basis point rate cut or another. It's the sum total of what we expect to see well into 2025.
Amanda Agati of PNC Bank. So again, we're looking at a mixed market right now with the S&P 500 index just about unchanged on the day. The Dow holding on to a gain now of 194 points, up 0.5%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now. You can get it wherever you get your podcasts. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
It's getting warm.
All right, thank you so much, Charlie Pellet. Carol Master, along with Barry Ritholtz, reading in. You're a busy man at these events.
I run around, I do a lot of things, I wear a lot of hats.
He wears a lot of hats. You know, he also does, of course, Masters in Business.
Yeah.
At the Money.
Yeah.
You run Ritholtz Management?
Ritholtz Wealth Management.
I forget what your title is officially.
$5 or so billion.
5 or so, right? And then
real money.
Real money, which is why he's a great co-host to have during this event, because we are talking about the management of real money, a lot of it. Want to get to our next guest, because we're delighted to have with us Scott Danner. He's head of the Legacy Division at the employee-owned independent wealth advisory firm Steward Partners, responsible for over $37 billion in client assets as of, I think, August 2024.
That's some real money, $37
real
billion.
money.
Yeah.
Firm founded about 10 years ago by former Morgan Stanley Barney managers.
Huh. So you have to explain
Smith Barney, like who are these firms?
Yeah, real firms. Smith Barney was a giant. So Legacy Division. First question, what does that mean?
So legacy is that next generation. You know, if you think about it, the succession epidemic in our industry is that the average age of advisors, successful advisors, is 58 to 62. And there's a challenge. What do they do when they're ready to step down? And there's a major gap. There are more 80-year-olds than 30-year-olds in our industry. And that's changing. You could see it here. But Legacy Division is, we had Freedom Street Partners, our company.
Mm-hmm.
We were acquired by Steward Partners last year. So I went to market, brought our company. We had $3.5 billion approximately, a good size real money firm as well.
Right.
But we needed that next level. And Steward had not done acquisitions. So we now come in as the mergers and acquisitions division. Legacy just means that next generation, that legacy division where we can help people that are looking for that next step in their practice or the final step.
Were you thinking about it when you sold your firm to Steward? Like, were you thinking about legacy as well?
Yeah, so this is what we specialized in.
Yeah.
So it's something that we had been doing. We built an entire model in and around that next chapter.
Right.
Legacy. We used to say, our job is to make you look like a hero on the way out, and we need to look like the hero on the way in to help you and your clients have continuity. So doing that at a $37 billion firm is a lot more fun because we have a partnership, a great Jim Gold, High Supporta, the team. They're phenomenal, and we're working together to build something special.
So you have all these solo practitioners out there working, many of whom are running $500 million, $1 billion. How do they deal with the issue of succession planning? Clients have to know, hey, if my guy's hit by a bus, I have to be able to access my money.
It's funny, I don't think clients ask that question enough, because if they did, our industry would probably look at it in a different way.
Right.
But most advisors don't have a very clean-cut succession plan, and if they do, they're not super happy with it. So if we look at it, a lot of advisors are looking to go into the next chapter of their career with next-gen advisors, and that means you have to do both. Like, this event's a perfect example. Future-proof, if you look around, there's so many young advisors that want to be a part of the next chapter of this industry. And you can't have succession without the next chapter of the industry. So if we look at these advisors that are looking for succession, it's really about identifying what's important to them, making sure that they know exactly what they're getting into when they do the transition, because that's a fear. They want to make sure their clients are well served and continuity continues. So there's so many things to think about.
Scott, I think about, and Barry, how many times we're talking about whether it's, Jamie Dimon at JP Morgan Chase or pick, whether it was, Bob Iger at Disney. You think about it, we talk about that so much because who is in that top spot really determines the future trajectory of a company. Same thing, though, with a financial firm, right? In terms of who's running it. I thought it was interesting. I'm thinking about the Bloomberg audience. Like, if you are investing with a firm, you want to know what they're thinking because the change at the top can impact how well your investments or how they do as a firm.
Yeah, I love the wisdom in our industry. I love the fact that there is no age that defines how good someone can be. But at the end of the day, a team approach is a great approach because if I have a demographic that identifies, think about how you receive your paperwork. If you're not getting it today with an app or a quick conversation or a fill in the blank versus the old ways where you were getting a pile of paper, the generational shift is important and it's our job to push. We push our parents in those ways. We push, the next generation always needs, and then my children push me. So we have to continue to do that in the industry. And I think it's really a great thing for our listeners to think about as far as continuity. How does my plan continue when I move on? And that's what the legacy division at Steward's all about, is helping the advisors create continuity plans that matter for their clients.
So let's talk dollars and cents. Back in the before days, when Fed rates were zero and RIAs were thought of as this great, reliable, almost like a preferred stock issuance, you had a great yield of 7, 8, 9%, and equity upside if there was acquisitions. People were paying some pretty aggressive multiples. Now that rates are much higher, what do you see in the landscape for acquisition? Is it still 10 and 15x? What does it look like?
Yeah, you go through this process and you learn very quickly. There's a lot of inflated numbers that get thrown around, and they can throw that around and then decrease your EBITDA, and it still looks really, really good, but it's not the same number. So I think the numbers are real. I think you just have to know where you fit in. Are you more of a single practitioner, do it, with $1 billion under management and having that consistent cash flow that's fairly low number of staff members? You're going to do pretty well, but not as well as the enterprises. The $5 billion firms are very attractive to us. We should talk. But these are the things. These are the things that are the most
Have
interesting.
you done your legacy planning?
We literally get calls every other week
from
PE, going back for way back when. And I remember having a conversation before we launched this, and I'm like, listen, we have this little project I can't tell you about. It's going to affect our valuation. I can't even talk to you about it. We have a different growth rate. We have a different business model. Every conversation we've ever had has always been like, well, thanks. Nice chatting. We'll get back to you. It's like, besides, I am having too much fun.
Right.
Yeah.
Why? I will freely admit, I have the best gig in all of finance. I get to work with Carol. I do stuff like this. I sit down in the office. I just had David Rubenstein in my studio for an hour and a half. Who does that? Why would I ever want to give that up?
I don't think you have to. I think the key is, and what you have to pay attention to is the life option. What you're talking about is your life is great. How do we maintain that lifestyle? And I think what's different is you'll never get a call from us.
Right.
I'm not recruiting. We're attracting people because we're focusing on what's important to you in your life. And that's what we're going to focus on in the next chapter. That's what the legacy division's all about. And I think in our industry, you're doing all the right things, all the things you love. What we have to pay attention to is when does that end? And how can we make sure that it doesn't end in a way that we're not happy with? We want to make sure that continues even for our clients and the fun continues.
So let me push this back to you. You're $37 billion. I look at shops like Cheryl Penny's Dynasty. They're over $100 billion. Where do you want to go? What are your goals?
Yeah, so our company's goals are to continue to grow. I was the first acquisition, so the beautiful thing is we are now acquiring a significantly high number of practices, and we've entered that space. We're still traditionally growing by recruiting the way that the Smith Barney guys always did, by just attracting great advisors and breakaway advisors. And I see us going from 30 billion to 100 billion very quickly. And I think as a partnership, that's very exciting for every single person that owns shares in this company, and everyone in our company owns shares, from our admin, to our marketing teams, to the advisors.
How does that impact culture?
I think it impacts culture in a great way, because being new to this entity in the last 9 months, what I could tell you is the sharing is significant. If you're doing something great, there's no hesitation for you to share it to somebody else, because if your practice is doing great and I share it with you, right, we're now elevating the entire firm's value. And that to me is something special. And I come from the old Edward Jones days where I started, and it was something that having partnership at Edward Jones was something really special. It was being a part of something bigger. Anytime you're a part of something bigger, a community, if you will, you're going to have a really great opportunity with culture.
Plus that ownership mindset permeates everything everybody does.
Yeah, it's an ownership mindset, which means you're not overspending in the wrong spaces. You're paying attention to, if I want to fly first class, I can upgrade, but it doesn't have to be at the firm's expense. There are things that you think about because you're trying to elevate the value of the firm and not just you.
Because what you do impacts the value of the firm, the success, but you also get a piece of that, so it'll impact how much that you have of that.
It's very special.
I think about a Bloomberg audience who's listening to this conversation. I have to say, I don't know that I had ever thought about legacy at all of these firms, and it was interesting kind of prepping for this event. So what do you think about the Bloomberg audience, investors who are listening to it, what they need to take away and think about?
Well, I'm a build better kind of person, meaning that if I think there's a better way, I want to know it.
Yeah.
If I'm a client sitting across from my financial advisor right now, I want to know what they're doing that's innovative. If we're only doing the same old thing that we've always done, now look, I'm not saying blow up plans. I'm just saying pay attention to the team, pay attention to the demographic, pay attention to the things that they're bringing back. And these are the things that if I'm listening and I'm thinking about this sitting across from my advisor, I'm just paying attention to something as simple as a succession plan. Is it written? Is it confirmed? Or is it just floating in the air like most groups? And that's something that I think is really important, because my financial plan that you continuously tell me to maintain, markets up, markets down, I maintain my plan. I need to know that you're maintaining my plan if you're here or you're not here. And it's very impactful.
It's so logical, right?
It's really most overlooked aspects of running a business. I can't tell you how many firms this is a giant gaping hole that they have to respond to. So if someone comes to you and says, look, we're not looking to sell, but we want to learn a little bit more about succession planning and we want to have a conversation, maybe down the road we're ready to do this. How do you work with firms like that?
I think about 30 seconds.
Yeah, I think at the end of the day, it's all about building relationships. So what we're doing is we're building a relationship to learn about your business, learn about what you're trying to accomplish, and how we can help you actually attain that. Most importantly, we understand your story, and we help you reach that goal that you're aiming towards, whatever it may be.
Scott, is the trend 10 seconds for much more bigger firms or smaller firms, or a little bit of both?
I think the trend is moving in an upward progression on both.
On both. All right, good stuff. Thank you so much.
Thank you so much for having me.
Really appreciate it. All right, Scott Danner, head of the Legacy Division at Steward Partners. I'm Carol Master along with Barry Ritholtz. We're going to drive to the close, folks. Don't go anywhere. This is Business Week live from Future Point.
3:40 on Wall Street. We do check markets all day long here at Bloomberg. Stocks are mixed as Wall Street debates 25 or 50. Let's head right over to the first word breaking news desk for today's afternoon call. And here he is, Bill Maloney.
And good afternoon, Charlie. That's right. The main U.S. averages are trading mixed right now, with the Dow currently up 223 points. The S&Ps are higher by 6, while NASDAQ is lower by 0.5%, helped by a drop in Apple. The U.S. 10-year yield of 3.62%. Gold is little changed. Oil is climbing, but Bitcoin, that's lower by 3.3%. Among the main 11 S&P sectors, only tech and consumer discretionary were in the red, and leaders to the upside in the Dow, Intel, Merck, and Cisco, while Apple fell 3% after an analyst warned of weaker iPhone 16 demand. In the tech space, Goldman Sachs' trading desk says buy the dip in AI stocks. And in other news, Boeing to start a hiring freeze and considers temporary furloughs. Wrapping things up, Intel rose 7% after getting as much as $3 billion in government funding to make chips for the military. Live from the first breaking news desk, I'm Bill Maloney. Charlie?
Okay, we thank you very much, Bill Maloney. And to hear live breaking news over your Bloomberg, type Squawk, SQUA, on your Bloomberg terminal. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no. Who's gonna drive you home? Honey, please, I'll do the driving. Drive on. Excuse me, I want to drive. It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, everybody, about 18 minutes left in the trading day. It is time for the drive to the close. I'm Carol Master along with Barry Ritholtz. We are live at Future Proof in Huntington Beach, California, and we've got, 2 days for that Fed decision.
That's right, Wednesday, the last day of this event, and I'll be halfway home when they come out and announce.
So you're going to get home and have to wait to read about it on the Bloomberg?
No, I'm waiting for Delta Wi-Fi. As long as I have Wi-Fi in the plane, I'll track it in real time.
That's a really good point. All right, so let's get to our guests because we're going to talk a little bit about the trade. Amanda Ribello is with us, Managing Director, Head of X-Tracker Sales at the DWS Group, the global asset manager. You might remember they were formerly Deutsche Asset Management, a little bit of a history lesson, part of Deutsche Group until 2018 when DWS became a separate entity. Welcome.
Thank you very much for having me.
How are you?
I'm doing really well. It's hard not to be doing well when there's sunshine and you're at the beach in California. So
not the worst setup to talk about investing in markets, right?
Exactly. Well, it's hard to remain focused, but I think so many stimulating conversations here that are giving us a lot of ideas. So,
what specifically? I am curious. There's a good mood, and I know it's California, and I know it's the beach, but it's interesting. It does feel like people are pretty optimistic. How do you see the outlook right now?
Yeah, I think, we were just talking about everyone waiting in anticipation of Wednesday, and I think that's been a major talking point in all of the breakout sessions that we've had this morning. Everyone's definitely in wait-and-see mode, as we see in the markets. And I think that we've had a lot of, great momentum in the markets over the past couple of years. But the number one thing that my team and I were speaking about to investors, prospects, clients is what's your view or your take on your current allocation to the Magnificent Seven? It's top of mind for everyone. Everyone is perhaps too long. Everyone is very aware of that, but at the same time, there's still this kind of FOMO aspect as well, especially after the dips last week, people wondering, should they still remain in? Should they top up? Should they actually rotate away to non-market cap weighted exposures within US equities? Should they even diversify to international equities? And especially given our German heritage, we've kind of been a go-to for a lot of investors on that side.
So what do you make of how the market has behaved since the Magnificent Seven has kind of stumbled? A lot of bears said once the generals trip, that's it, it's all over. And instead, it seems like the market is broadening out and there's more participation. That tends to be healthy, doesn't it?
S&P 500 equal weight hitting a record, all-time high today.
Absolutely. We actually have this fund in Europe, and we love it. It's been one of the top sellers in our UCITS range. From our side, within the US range, we kind of are thinking more about how can we provide some more sector diversification. I think everyone is very long tech, but like you said, Barry, it's really good to see that at least you're not just in just a few names. Now it's extending kind of along the tail, which is very healthy. You know, it's really funny to see that the ETFs were first launched globally in 1990, and you know, one of the key elements of them was the diversification trades, to have diversification in just one CUSIP or ISIN, and that's very much like coming back. You know, it's ever relevant, which is fantastic. What we're really liking at the moment from that diversification perspective is to still not have too much propensity to just one sector, but obviously there are some sectors which are more important than others. We like the equal weight, but at the end of the day, it's just thinking about the number of names in each sector. So maybe, you know, there's a version 2.0 that we're trying to work on our side. But what we really liked is about picking the winners within each sector. So we've got our S&P E fund. It's just crossed its 5-year mark, its anniversary. And what's really good is that it's sector neutral versus the broad-based benchmark, but you're actually picking the winners within each sector based on ESG scores from S&P, the index provider.
People still want ESG?
Well, the thing is, you know what? It's still a lot of cynics, and I think that a lot of people have thought, oh, it just equates to environmental, but in reality, the social component, but more importantly, the governance component, this is what stock analysts are looking at anyway.
Which seems to be more easily to measure.
Exactly, yeah. There's so much data and everything that we have, so, you know, just to encapsulate it in an index is very easy. I think frankly, you know, all of us are looking for the unicorn is always to outperform the S&P 500, and actually this fund is doing that. So it's outperformed by about 1.55% per annum since inception.
Wow.
Which is incredible, and it's not been by playing any sectors or anything like that. So that's really positive.
The governance side seems to act as a risk screen to pull out some really bad actors before they start acting badly.
Exactly, absolutely. So it's usually typically a buffer on the downside, but what's been really great to see with this outperformance is that even in a market that has rallied over the last 5 years, you also captured more upside as well, which is fantastic. So what you end up with is a lower downside capture and then a higher upside capture, which is, you know, what we're all striving to do in our industry.
That's how you outperform.
Exactly, absolutely.
How does AI play into your world in terms of what investors want, but also how you guys actually, you know, create funds, create investment vehicles?
Yeah, we love AI. I mean, one of the greatest things that we're most proud about at DWS is that we actually have the largest AI fund in the world. It's our UCITS XAIX. And being a global player, we're able to kind of take ideas from both sides of the Atlantic. Maybe one of the reasons why I came over from the UK to the US, and then one day I go back maybe. But this fund is, we've just launched it in the past couple of months here in the US for US investors, and great to have this fund. There are a number of different funds already in the market, but what's very different about this fund is that it's forward-looking. So we actually, it's a bit meta in fact, we use AI to capture AI, so we use natural language processing to identify the patent universe, and so we're thinking then about which stocks are going to benefit more, are going to have better forward-looking revenues, which obviously then helps with the valuation of the stocks rather than just which are already existing players in the market.
What's the vehicle for this? Are you using ETFs, mutual funds? How does it roll?
We're using ETFs, and very typically speaking at DWS, we are launching more ETFs than mutual funds these days. Last year we launched around 7 new funds, and this year we're kind of aiming for a similar number as well, and probably next year going to 10 or so. The reason why is we're just listening to what the investors want, and the investors are saying that the ETFs time and time again are helping them with their businesses, with their investment needs and so forth. So we've actually launched our first active ETF, which I think is the real confirmation of that stance, which is our natural resources ETF, which we just launched this year, NRES. And that's been a collaboration with one of our strongest platforms at DWS, which is our liquid real assets REEF platform. So leveraging their expertise in terms of identifying equities which are very highly correlated to the commodities markets, but without taking the volatility of commodities markets.
You mentioned that you wanted to move a little bit away from the concentrated Mag 7. Any particular sector standing out? We only have about 30 seconds left.
We are really liking international equities, and especially if they're FX hedged or if there's a value component like dividends in them.
I feel like people have been talking about the international aspect for about a year.
Eventually, that mean reversion is going to kick in, but it's been a long time coming.
Nice to catch up with you.
Thank you very much for having me.
Appreciate it.
Have a good day.
Amanda Rebello, head of X-Tracker Sales at the DWS Group.
This is Bloomberg Business Week with Carol Massar and Tim Stenivek on Bloomberg Radio and Television.
All right, everybody, we've just got about 7 minutes to go until we get the closing bell on Wall Street. I'm Carol Massar along with Barry Ritholtz. I know, it's like that puzzle, you know? You okay?
Now I got it going. It's a little windy out here.
It's a little windy out here. Carol Massar along with Barry Ritholtz here at Future Proof. I don't know, you've been having a lot of conversations. I'm just curious, what do you think about the mood here and what's top of mind? I mean, if we were back at Bloomberg headquarters, it would be Fed, Fed, Fed.
Right.
I feel like there's a lot more.
Very different. First of all, you know, as a longstanding veteran of financial conferences, it's hard to have any sort of sense of depression or doldrums when you're out here. There's a lot of young people. There's a lot of energy. It's blue skies. It's California sunshine.
Yeah.
Like half my team took a surfing lesson Sunday morning. So it's really...
Do you hear that, bosses back at home?
It's tough to really, the vibe session negativity. You can't be here and be unhappy with how the state of the world is. But people here are genuinely interested in learning how to improve their practice, get better at what they do, grow. And there are a lot of different ways you can access that content. The meetings, the speed dating that takes place here on a business level, they're going to have 32,000 meetings. There is, as Scott had said, a demand for that relationship, that networking. This is the driver here. People want to make in this age of AI, they want human contact, they want to network, they want to be able to see people that they can work with, they can find out what best practices are, and figure out, hey, how can I be better at what I do?
Better for their investors that invest with them.
Better for their investors, better for themselves as a business professional.
Right.
Better, you know, the yoga and wine tasting classes, that's not your usual financial conference thing. It's, hey, how can you be the best version of you? And I am not a woo sort of guy. Like, you and I both know Dave Notting.
I'm a woo kind of gal.
Right? Dave Notting and I always laughing about this. He's much more meditative and woo than me. But still, anybody who wants to improve themselves, their professional skill set, their relationships, both personal and professional, how can anyone object to that, especially in an environment like this?
Having said that, to be fair, you are someone who loves to consume information.
I'm a
listen
junkie.
to your interviews.
Absolutely.
And all the people here, though, are very interested in kind of understanding what the trends are when it comes to how do I get the best investment performances, you know, and it's the things that we talk about. I was here yesterday and there was a slew of cars that went by and it was a political parade. There's just all these factors that are going on that are impacting performances.
So a lot of this is...
So that's also talked about here.
Right. It gets discussed, although this has been surprisingly and pleasantly apolitical.
That is true.
There's been no political talks. The concept, if you go back to the data, hey, it doesn't matter who wins. It matters who wins the election. It probably doesn't matter very much for your portfolio over the long run.
Right.
Goldman Sachs said some things about GDP and what inflation might happen under this candidate or that candidate. I won't enter that morass. But for the most part, the market's done well under Democrats. The market's done well under Republicans. I think the long haul is what matters. But that's not really the focus here. The focus is, hey, what can I do to build my investment portfolio? So they're looking at ETFs. They're looking at how do I get AI exposure? How do I use AI in my practice?
Right.
And the general concept of there's a place for passive, but there's also a place for some ornaments on the tree, I like to describe it, right? You want to put a little garland, you want to put a little stink on it. Hey, here's a momentum fund. Here's an equal weight ETF.
Right.
That's fine, but you have to understand where the core of your investment portfolio should be.
10 seconds, is it getting easier or harder, you think, to manage money?
Oh,
There's so much information out there, but that can be great, but it can be...
It's getting so much easier because the technology is better, the products are better. It's just, you could do things today you couldn't do 10 or 20 years ago.
All right, don't go anywhere. Barry Ritholtz, Carol Massar. We're going to continue from Future Proof in Huntington Beach, California. I'm looking at just a couple minutes left in the trading session. We've got slight gains on the S&P and the Dow Jones Industrial Average up about 263 points. NASDAQ 100, a decline of 81. This is Bloomberg Business Week, live from Future.
It's 3:58 on Wall Street. We do check markets all day long here at Bloomberg. We've got 2 minutes to go ahead of the closing bell. We begin with a developing story and a headline right off the Bloomberg Professional Service. Tupperware brands planning bankruptcy as revival efforts falter. That story breaking right now. We've got, again, those headlines out of Tupperware, planning a bankruptcy as revival efforts falter. Stocks mixed ahead of the close. The Dow higher, S&P 500 index advancing as well. But right now we have got NASDAQ in the red, NASDAQ moving lower. We've got the NASDAQ Composite Index down 87 points. The NASDAQ 100 Index falling 85 points, down 0.4%. S&P, as I mentioned, advancing right now, up by 9 points, a gain there of 0.1%. Dow Industrials up 257, up by 0.6%. 10-year 3.61% with a 2-year that's yielding 3.55%. Spot gold up $5 the ounce, up 0.2%. West Texas Intermediate crude oil up 2.6%. Veronica Clark is director of Citi Research at Citigroup Global Markets. She says the 25 versus 50 debate may get settled tomorrow morning.
You can make the argument, of course, I think, for going 50. Of course, we did have those stronger inflation data points last week, maybe causing the hawks a bit of to be a bit uncomfortable. So right now, thinking they just do 25, but we'll see retail sales tomorrow. This is a very close call, of course.
And that number drops 8:30 a.m. Wall Street time. Veronica Clark of Citigroup Global Markets. So heading into the closing bell, there you have it. We're up 6 points right now, 56.32 on the S&P 500 index, up by about 0.1%. Folks from Lemonade ringing the closing bell. We've got the Dow Jones Industrial Average up 238, up 0.5. NASDAQ again, scoring a gain on this back-to-work Monday, a mixed Monday. The S&P up by 0.1%. Briefly, Apple shares declined today, down 2.7% after a closely followed analyst, Ming-Chi Kuo at TF International Securities, warned that demand for the firm's new iPhone 16 Pro model has been lower than expected. Recapping, 10-year, 3.61%. S&P scoring a gain today, up 7 points, up by about 0.1%. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Tim Stenevec on Bloomberg Radio.
Hi, everyone. This is Bloomberg Business Week. I'm Carol Masser along with Barry Ritholtz, who just said, did you smell that? What was that? That's
hamburger, some sort of meat is grilling. It's delicious.
Somebody has not had
right. I'm late for my noon feeding.
Barry Ritholtz, he's Chairman and Chief Investment Officer of Ritholtz Wealth Management. I'm Carol Masser, of course, of Bloomberg Business Week. Barry, of course, host of Masters in Business and At the Money. We're here at Future Proof in Huntington Beach, California, and we've got an incredible 60 Minutes coming up. Sarah Malik join us a little bit later on. But right now we want to get to our first guest, and that is Priya Misra, who is with us. She's Portfolio Manager of Global Fixed Income, Currency and Commodities at JP Morgan Asset Management, joining us here at Future Proof. How are you?
I'm great. This is beautiful. Thanks for having me.
Well, thanks for being here. I know. We always talk about taking the show outside. You know, when you're in college, you're like, let's take. This is what we are doing today.
We are outside.
So I want to ask you about the elections, because we have some reporting, and it noted that a Kamala Harris victory in the elections is seen as better for treasuries, worse for stocks. Than a win for Donald Trump. This was a Bloomberg Terminal subscriber survey. Are you thinking about the elections and what it means for the investment universe, and what does it mean in your view?
So we're all definitely thinking about the elections. It's a big election. It's a very close election. But I'll make a couple of points. You know, the presidency is clearly extremely important, but Congress is very important to get a lot of things done, you know, or not done, because the 2017 tax cuts are likely to expire if Congress doesn't do anything. So beyond the presidency, we're looking at the Senate races, the House races. So the entirety of the election is going to be important. Secondly, there's a lot of policies that are up in the air, right from tariff, immigration, regulation. I talked about taxes, spending. I think it may be a little simplistic to say that one outcome is necessarily good for the economy or good for markets. I think we also have this deficit issue, which is out there. If the
either of them.
For either of them, exactly. Whether it's spending or it's taxes, or tariffs, they all have fiscal implications. I mean, what I'll say is, as I manage our portfolio, is we're not positioned for one way or the other. It really, from a risk-reward standpoint, given that the election is won by not a lot, 40,000 votes or 100,000 votes, we're talking not about, a very clear divide here. So I would say it's best not to position before the election, to see the election outcome, and then to see what policies are prioritized. Is it going to be taxes first? Is it tariffs first, which is going to have a very different implication? There's also, so I would say when we look at the election and the outcome on markets, I look at the impact on growth and inflation, I look at the impact on the deficit, and then what I really hope is Fed independence remains, but that is, I don't think we should take that for granted. Is there any impact there? Because that's going to have an impact on treasuries as a safe haven, the dollar as a safe haven. These are all things which require an independent central bank. So there's a lot, but I would say...
You really did say Fed independence. You really are concerned.
I am a little concerned.
Wow.
I mean, we've seen this little bit before, and I think now with the fact that, the Fed was late in hiking rates, are they going to be late in cutting rates? They're about to embark on a cutting cycle. And if we have the president or Congress talk too much about Fed policy, it's not great to inspire confidence in the U.S. capital markets. And we need foreign investments. And as the Fed cut rates, I actually think foreigners will look at U.S. fixed income. They'll look at the U.S. equity market. So I do hope that Fed independence remains. I think it's something we should keep at the back of our mind as we think about market implications of the election.
So the Fed has taken rates high enough that money market funds are yielding over 5%. They now stand over $6 trillion. That's a lot of money. What happens as the Fed begins to cut rates? Where does that capital go looking for yield?
Sure. And that's the question I would say every asset management person, every wealth manager is salivating at the thought of that $6 trillion. Historically, that money does move, once the Fed starts to cut rates, it starts to move first into fixed income and then into risky assets. But here's the catch. We're in a soft landing, and soft landing rate cuts are rare. So can we apply the historically, the Fed is cutting in a recession. So the money moves into fixed income because, well, equities might look a little scary. This time round, if the soft landing is maintained, and that's an if, I think there's a case we're in a good spot. If the Fed was to cut rates quickly enough, we might stay in that soft landing. We have a chance. It's a narrow path, but I think there's a chance we stay there. I think that money moves into different asset classes. Not all of it. There is a reason people own cash, liquidity, cash management. But a certain portion of it, especially as you realize that there's reinvestment risk, that money is not going to stay at 5% as the Fed cut rates, and forwards are arguing for a little below 3%. That cash is going to give you 3% as people start to internalize that. And I think the Fed cutting starts that money then in a soft landing moves into equities, credit, and government bonds. If the economy slows down, I think you're going to see more into fixed income. So there's a bit of a bifurcated outlook for that money depending on how the economy evolves from here.
So it's interesting, when the Fed was raising to a longer duration bonds get a little bit punished. 2022 was a tough year. If the Fed is starting on a longer cycle of rate cuts, and some people have talked about high 3, low 4% is where they end up, what do you do with your duration? Where do you want to have your bonds? What sort of longevity are you looking for in the holdings?
Sure. I think bonds finally give you income. So I joke that fixed income finally has income in it, which is good. Real income. Not only are you getting that nominal income, but net of inflation, you're actually earning real returns. The other thing bonds are giving you is diversification, which you talked about 22. It was the opposite of diversification because risk assets struggled and bonds struggled. That's changed. And actually, you don't have to take my word for it. Look at the last couple of months, just the last 2 payroll reports that come in a little weaker than before. And this fear of a hard landing or a recession starts to come up. Risk assets struggle and bonds do really well. So when you talk about a longer-term perspective, I think there's a lot of talk that's been that has happened that 60-40 is dead. No, 60-40 is back because that fixed income component is giving you that diversification. So we've actually been adding to, because we're in a soft landing, we have risk assets in the form of spread, high quality investment grade, high yield spread, securitized spread. Owning some duration is a good hedge. If the economy starts to slow down, our spread products will underperform, but then that treasury long, and we're long intermediate. I think the 2-year doesn't give you that much. You start to go long 5s and 10s. We should not worry that much about whether they go 25 or 50. Let's look at the totality of cuts.
Where they end up.
Exactly. Where they end up is right around 3%. We're not pricing in a recession. So if we do get into a recession, at that point, the Fed's cutting to 2%, 1%. There's a lot of room in terms of price appreciation for that duration. So I like adding duration. We're buying any backups. Any election-related, you talked about elections, so I bring that up, any election-related volatility, supply and auction that doesn't go well. Anytime interest rates rise, I think it should be viewed as a buying opportunity to add that duration, especially if you've got risk assets on the other side of your portfolio.
All right, we're going to leave it on that note. Priya, thank you so much. Really enjoyed having you. Priya Misra joining us, of course, Global Fixed Income, Currency and Commodities, Portfolio Manager at JP Morgan Asset Management. Thank you so much. Appreciate
Thank you.
it. Hey, folks, I just want to bring you some headlines from Intel. We do have just crossing the Bloomberg terminal. It looks like Intel specifically, the company's CEO has landed Amazon as an AWS customer for the company's manufacturing business, potentially bringing work to new plants under construction in the United States, boosting his efforts to turn around the embattled chip maker. So we're seeing some headlines there. I thought I saw one other headline also, to pause Poland, Germany factory projects by about 2 years. So we know the woes. We've talked about it a lot. I highly recommend that you check out some of the reporting that's being done by Ian King that really talks about how this has been long in coming. Intel shares, though, on these headlines, folks, in the aftermarket, we're seeing the stock pop around 11% here. So we'll continue to watch that. All right, want to get back to Future Proof. Carol Masser, along with Barry Ritholtz here, and want to get to an interesting guest, Christian Faze. Hi, Christian.
Hi. Thanks for having me.
Well, thanks for being here. He's founder and CEO of Faze & Company. I can describe the company, but I'm going to let you describe it. Tell us what you guys are up to.
Absolutely. Thank you very much. It was great to be here. Great sort of venue to have a conference. So we're a private credit fund. We run a private credit fund that gives accredited investors the opportunity to get exposure to what we think is a really interesting asset class, and that's real estate bridging finance against residential property.
Something you know a little bit about.
I do know a little bit about, yeah. So I've been involved in the sector for almost 20 years. Originally was a lawyer, grew up in Australia, which you might be able to tell from my accent.
Spent time over in London.
Spent time in London, yeah. So recovering lawyer as well, Barry. So happy to be an ex-lawyer, that's for sure.
Half of the lawyers aren't practicing 7 years after graduation.
Why is that? That's another podcast, maybe.
That's a whole nother conversation. So what sort of real estate do you guys focus on? Is it just residential, or is it a variety of sectors?
No, it's residential. So we're very careful to explain that to investors. Obviously, there's parts of the real estate market that are quite troubled and sort of making headlines, like commercial and different parts. But we're small balance, single family residential. Our average loan size is $450,000. So it is kind of really targeting what we describe as property entrepreneurs buying the worst house on a nice street, replacing the bathrooms, kitchen, and then selling for
kind of the flip, right?
Yeah, it's fix and flip. It is fix and flip finance, and it's a big market in the US. It's a big opportunity, and like you're saying, I've done it. Built a business in the UK that was very active. The fix and flip market, that's now the largest non-bank mortgage lender in the UK, and now been active in the US for the last 2 years, and it's a huge market here.
Are these the investors who are like constantly sending me texts and saying, I want to buy your house? Are these the people that you like are dealing? No, seriously.
I get those all the time.
Right? Like,
I get those on houses I don't even own. I'm like, yes, send me a check.
You definitely want to sell that one.
Well, that's what I'm like,
in.
Here's my price, and it's like, some crazy number. You want it, it's yours. But tell me, like, is
they
that,
are. I mean, like
who
I say,
are you dealing with?
We describe them as property entrepreneurs. I mean, I think that it's a bit of a misnomer, because a lot of people turn on the TV and see the glamorous couple, flipping houses, making lots of money, and it all looks quite easy. It's not that. In reality, it is kind of, they're real hustlers. They have to work hard. And we target property professionals. They're doing this full time. and they do it multiple times a year, so 5-10 times a year, and so they're good customers for us. Once we acquire them, we can be their funding partner of choice. They keep coming back to us, and so it's a very entrepreneurial borrower, but a great product.
So my brother has been doing this for years,
right?
Sort of a side hustle, but he does 4 or 5 houses a year, and the conversation has always been, hey, I'm funding this primarily with my own money. I asked him, have you thought about getting venture funding or any sort of credit for this? Because you could turn this into 8 or 10 houses a year if you really want to. And it's some of these houses are fairly. It's not always the worst house in a nice block. Sometimes it's a very nice house on a really nice block.
Yeah. Well, I'll have to give you my number. You can give to your brother for afterwards. And we say that as
the
well.
deals happening at Future Proof.
we people that are not trying to sort of maximize leverage. So the average LTV across our books less than 60%. So they're pretty conservative, but with a bit of leverage, they can do a couple of projects as opposed to being exposed to just a few, a lesser number. And there's a lot of tailwinds for the asset class. There's just fundamentally not enough houses being built here in the US, the same as in many parts of the world.
Yeah, but that's a whole other story because it's in terms of acquisition of land, and you've got to get neighborhoods to sign on. It's not just a case of here's the money and build them.
No,
and
sure,
they will
it's
come.
not just a funding issue, but then the other sort of addition to that is that over 60% of housing stock in the US is over 40 years old. So you do have a lot of aging stock that does need to be refurbed, and so with not enough housing stock and a lot of older stock in the market, refurbing is is something that's very much needed.
Something I've got to ask you though, and I'm curious about what your brother says, is that there are people who want to do projects. There aren't plumbers, there aren't electricians, there aren't contractors, and there isn't a younger generation. I have 2 contractors in the family too, but there's not a younger generation who wants to do this kind of stuff.
Yeah, definitely. And I think through COVID, that's been a difficult time as well. Costs have increased.
But even still.
Yeah, even still. Yeah, it's tough. And also, you don't have a lot of end borrowers that want to take a 7% mortgage to buy the end product. So it's kind of a time of disruption. I kind of see that as a time of opportunity in many respects. Banks aren't active in this market. They're just not really equipped to provide the quick sort of streamlined finance that we provide. And so, so I think it's a great opportunity for investors to get a superior risk-adjusted return against what is a relatively liquid underlying asset class.
So you're talking about the age of the housing stock. Did I get this right? 60% of the homes are 40 years old or older.
Yeah.
So we're talking about refurbs. I see a lot of knockdowns in some of the neighborhoods, either by my house or out by the beach or anywhere else. It seems like a lot of contractors are just, hey, let's not fix this. Let's just build a bigger one.
Yeah.
Is that a space you work in also?
So we don't. So we think that a ground-up construction is quite a significantly higher risk proposition to be investing in. So we try and focus just on fix and flip, where it's not sort of changing the construction of the build. It's really just a tart up and then an opportunity to sell, because we want it to be quick. It's 12 months or less in duration, our funding. Typically, it's
that's quick.
It is quick, yeah. But the typical borrower comes to us and says, "I only need it for 3 months." Yeah, exactly.
3 months.
It takes a little bit
longer.
longer. Yeah. But it's quick, and that helps the underlying investors because there's a lot of volume of loans underlying.
So what's the relationship between you and the fixer flipper? Is it just a credit relationship? Do you do anything with them? How does the participation work?
So it's a direct relationship. So I think that's one of the advantages of our fund as well. We're not sort of buying loans originated by other originators. We have a direct borrower relationship. That means we're very close to the underlying credit. We can sort of understand what that borrower's true circumstances are like.
You want to make sure this works.
We want to make sure it works, yeah. And it's a relationship lend. We ideally want to be the preferred funding provider. They come to us once, they have a good experience, we get to know them. Once a borrower repays us, the risks around fraud and the things that sort of keep you up at night are significantly diminished. So we want to sort of be, finding good customers, lend to them again and again.
I don't know if I missed this. Did you say what a typical loan, like what the rate is? And I'm just curious about the returns on these types of investments for you guys.
Yeah, sure. So I'm not sure if I'm allowed to talk about our investment returns in our fund, but we offer investors a fixed return of 10%, and we're lending out at about 12% per annum. So there's a bit of a margin there for us, but it's a good sort of risk-adjusted return for our investors. We say to our investors it's 1% a month. So the typical borrower does come to us and say, I only need it for 3 months. Maybe it ends up being 6 6 months, but it's 6% is the cost of the funding for them. And what we say to the borrowers, if they're too tight on the margin, then they shouldn't be doing the project. You know, that's kind of just a cost of doing business for them.
Traditional lien on the property, the usual mortgage stuff?
First lien. Yeah, so our head of underwriting comes from a bank, who are sort of experienced team. We say we do everything that a bank does. You know, we FICO score the borrowers. We look to make sure that we're only lending to corporates, but we look through to the individuals and make sure that they're credit-worthy individuals. It's full recourse against those individuals, and it's first lien security against the property.
Just 15 seconds. Is there any area in the United States that's particularly hot that you're working in, or is it all over?
We're quite selective in the States. Florida's a very strong market for us, but it's been on the up, so I guess you watch closely.
You know, it's a great interview when you still have like a million questions.
Right.
Christian, such great stuff.
Yeah, lovely to meet you. Thank you.
Thank you. Christian Faze. He is founder and CEO of Faze & Company. We're headed for a break, folks. More from Future Proof with Barry and myself. This is Bloomberg.
It's 4:21 on Wall Street. We do check markets all day long here at Bloomberg, and we begin with a pair of developing stories on a day when the Dow Jones Industrial Average climbs to a record. Intel CEO Pat Gelsinger has landed Amazon's AWS as a customer for the company's manufacturing business, potentially bringing work to new plants under construction in the U.S. and boosting his efforts to turn around the embattled chipmaker. And Tupperware Brands is preparing to file for bankruptcy as soon as this week. This according to sources, following a years-long effort to revive the business amid waning demand. S&P up 7 points to 56.33, up by about 0.1%. The Dow up 228 points, a Dow record today at 41,622, up by about 0.5%. Nasdaq fell 91, a decline there of 0.5%. 10-year 3.61%, the 2-year 3.55%. Spot gold today up $5 the ounce, 25.82, up 0.2%, while West Texas Intermediate crude today up by just about 2.6%, 70.47 a barrel. Fed policymakers will be meeting Tuesday and Wednesday. We'll have the news conference and Jay Powell's decision on Wednesday. We'll have that for you live here on Bloomberg Radio. There are questions about whether it'll be a 25 or 50 basis point cut. Priya Misra is portfolio manager at JP Morgan Investment Management. Moments ago here on Bloomberg Markets, she told us she is concerned about Fed independence.
We've seen this little bit before, and I think now with the fact that, the Fed was late in hiking rates, are they going to be late in cutting rates? They're about to embark on a cutting cycle. And if we have the president or Congress talk too much about Fed policy, it's not great to inspire confidence in the U.S. capital markets. And we need foreign investments.
JP Morgan's Priya Misra interviewed moments ago on Bloomberg Business Week. Briefly, Amazon CEO Andy Jassy ordering the e-commerce company's employees to return to the office 5 days a week beginning in January. Recapping, S&P up 0.1%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Carol Masser, along with Barry Ritholtz, we're live at Future Proof, having some fun. Huntington Beach, California. How could you not? I want to set this up a little bit.
Okay.
Bloomberg News story that was recently out just last month talked about the $1.7 trillion private credit industry. You talk about it a lot. We talk about it a lot, how it's grown so much as higher rates have basically forced buyout firms to look further afield for funding while traditional lenders pull back. We know the story.
Mm-hmm.
What's interesting is banks have now become more competitive in recent months, trying to regain the leveraged loan market. So they're starting to get a little upset. In response, we've talked about credit funds starting to push their pricing down, raising concerns about a potential race to the bottom. So that's my setup because I want to ask our next guest whether that's what's going on. Alona Gornick is Managing Director, Senior Investment Strategist at Churchill Asset Management, which, as we like to remind everybody, is the $50 billion private capital affiliate of Nuveen. Welcome, welcome.
Thank you so much for having me, Carol Berry.
I feel like we know so much about Churchill. You do in particular, but I've also talked with Ken Kinsell. So a lot about what's going on. He often talks about just being the golden era of private credit. But are we seeing a little bit of a race to the bottom as banks are getting more involved? Tell me what's happening in terms of the deals that are going on right now.
Sure, it's been a really interesting competitive landscape. As we think about the different segments of the middle market, I feel like they are individually each facing this sort of bank pressure in a very different way. I think a lot of the activity you're talking about is largely hitting that upper middle market segment, which makes a lot of sense for corporate borrowers of the size that banks really want to attract. In the core middle market where Churchill's focus, we generally see a little bit less of that bank interaction or bank threat, if you will, in that same traditional sense. But generally what we are seeing is a little bit more competition for the most part, with some upper middle market direct lenders somewhat coming down market, given there isn't as much activity that they can pursue in that upper middle market, or a little bit more of a competitive threat. They might want to expand their wings, if you will. But there are ways in the core middle market where we can really expand and stay disciplined and avoid some of that race to the bottom, which can come in the form of maybe tighter spreads, looser covenants to no covenants, coming down in market in terms of the size of the business, which is really where we want to stay away from.
So private credit really seemed to navigate the rising rate environment pretty well. Most of the various funds and deals form of SOFR plus some upgrade. So as rates go up, SOFR rises, replacement of LIBOR, and you guys seem to maintain a fairly robust spread and pretty good returns over time. Who are you targeting with your products? These tend to be locked up a little longer than I think a lot of RIAs are used to. Tell us a little bit about who you're marketing to and why you're at this event.
Sure. So private credit has generally been very focused on the institutional market. It really makes a lot of sense to have committed capital locked up where you can draw it down over time as a manager. But what we've seen has been incredible opportunity set in the wealth market that is just tapping the surface, right, of starting to explore private markets, private equity, private credit. But in size, the wealth market is equal in terms of the institutional market. So think about going from 0% effectively up to 5%. When you think about institutions and their exposure to private credit, they're generally anywhere between 5 to 15%. I mean, CalPERS was out, I think, last week talking about targeting 5 going to 8%, massive institution. Think about the wealth channel, getting from 0 to even 5. That's a huge untapped opportunity that we would like to meet. But to do that, we need more accessible products. It has been very difficult to think about wealth coming into a product that has a $5 million minimum. That is nowhere near what a wealth manager or an advisor can touch. So we're really focused on this market. This is a great conference to do it. There's about 2,000 advisors here. But when I think about the wealth channel, I think there's about 300,000 advisors. It's so fragmented. How is Churchill going to access this market? So we absolutely need education. We need resources. We need distribution folks on the ground all over the country. We need specialists to help with that education. And we need partners, you know, like technology platforms like CASE and iCapital help us create funds and ultimately product development that have lower minimums, these non-traded, perpetually non-traded BDCs that allow you to come in for $2,500 instead of $5 million. And 1099s, much more easy to access, really simple.
Really, really interesting.
Do you think investors are ready for the possibility of it having higher risk as an investment, or also having their money maybe locked up and not as liquid in these kinds of deals?
I'd say the top 3 concerns, or at least hesitation points that advisors have when I'm on the road, are number 1, the liquidity risk.
Right.
Number 2, default risk in the asset class that they're not very familiar with. And number 3, it would generally be, you know, accessibility. Like, how am I going to get access to this product and comfortably get it if, in fact, we are in a rate declining environment? Well, how will that impact my return picture? With liquidity, you have to really educate folks that these are ultimately not traded assets, right? We're putting it in a wrapper that affords you potentially some liquidity and a quarterly redemption, but underneath it, the assets aren't really meant to trade. So you really have to educate the client on thinking, if this is something in your portfolio that you will not touch for a very long time, enjoy current income along the way, that's what you want to really think about, and diversify the portfolio with enhanced return. I think that's what's really resonating.
What's the typical lockup period?
So we don't have one in these funds. In a non-traded BDC, you're actually, first 12 months, you'll have a soft lock at 98, but then after that, you can really redeem your entire amount up to a cap, where we as a manager would cap it at 5% of the NAV of the fund.
So really that window, and we saw this craziness with B Credit and B REIT earlier this last year. I've always thought of that as, I call it the widows and orphans redemption. If you're, and my favorite story is surgeon, 47 years old, wife, 2 young kids, suddenly passes away. They don't want to be in an illiquid thing, and so that's what that 5% is really for.
Yes.
So for the typical client who's not, they expect to hold this for 3 years, 5 years, 7 years. What sort of expectation do you have?
I think what's great with advisors is really trying to help them educate their clients about a very long-term hold here. I think what's really resonating in terms of benefits about private credit are, 1, that income generation. It's incredible to think about income generation in terms of a predictable path to retirement. So if it's on your way or when you're in retirement, that is a multi-year potential investment addition to your portfolio. But if you think about the income component of that, it's very similar to fixed income and public credit, but with a really nice yield premium to it. And you were talking about this earlier. Historically, the yield premium for private credit, particularly direct lending, versus the upper kind of large corporate credit, has been anywhere between 150 to 250 basis points. That's pretty historically kind of where the average has been, around 200, Right now, we're actually seeing it widen out to about 250, 265, which has been because of that comeback in the bank market. When things come back, activity picks up, spreads tighten out, but not as much in that middle market. So our premium is actually increasing. So current income is really going to be really attractive for advisors when they think about multi-year in terms of, is it 3, is it 5, is it 7, is it for the long haul?
Is there any stress that you guys are seeing? I mean, I do think that there was, milk in the last couple of years and milk in this year, like the concerns about stresses in the private credit area because we feel like that there isn't enough transparency. You know the arguments, but I'm just curious, renegotiating the terms of deals to make sure that, there's no defaults and that you can kind of see the deal through. What are you seeing on that front?
I think that there are pockets of stress or distress happening in the market, and I think it's going to be vintage specific.
Still.
Yes, and actually showing its ugly head a little bit more so when you think about the most aggressive deals were generally done in and around the time when we saw massive recovery post-COVID, a la 2021. Valuations were really high, really fantastic software, healthcare services businesses were getting bought for, double-digit multiples, and along with that came a pretty heavy dose of leverage. Pretty easy kind of money, very low to no covenants. It's that which we're seeing. If you had any issue before COVID and now in an interest rate environment that's been twice as high as it was 2 years ago, you're going to feel a little bit of pain right now. So we're starting to see a little bit of that unfold. So that stress, those cracks, but I'd say it isn't broad-based across all of private credit. I'd say it's sort of isolated to vintages and then even certain parts of the market where you took a little too much leverage than the business should be able to handle.
So let's talk a little bit about the industry itself. We've seen broad adoption of private credit when rates were really low and double-digit growth every year. How much longer can this sector continue to grow at such a rapid rate?
So we get this question a lot on the road in terms of, is this growth a bubble? How much of this is sustainable? And it's important to think about this, and I know you've talked to a few of my colleagues, where we look back at the growth so far. If you really unpack that, a lot of it has been really more secular driven rather than fad driven, right? These are changes that are evolutionary in nature that had to happen at some point, where you had for the first time a commensurate demand in both investors' interest in the asset class with that search for yield in the low rate environment, and borrowers who are really looking for a more efficient, customized, speed to certainty of execution type of solution. And both of those happened in lockstep. But now where are we? We're not in a low rate environment anymore, right? Borrowers already know that this is a fantastic customized solution. They can avoid going to S&P and Moody's, but what's going to push it to the next level? And I think what we've got is looking at dry powder that's on the side for private equity. Massive amounts of dry powder that still needs to be put to work. And if you think about every dollar private equity that's put to work, there's typically another private credit dollar put to work if you think about a 50-50 debt to equity structure. So I do think that there will be sustainable demand going forward.
A great overview, certainly, of something that has become hot. And I feel like year after year after year, we talk so much about what's going on in private credit. Ilona, thank you so much.
Yes, definitely. Thank you for having me.
Ilona Gornick, Senior Investment Strategist at Churchill Asset Management. You are listening and watching Bloomberg Business Week from Future Proof.
It's 4:40 on Wall Street. We do check markets all day long here at Bloomberg. After the bell, we learn that Intel CEO Pat Gelsinger has landed Amazon's AWS as a customer for the company's manufacturing business, potentially bringing work to new plants under construction in the U.S. and boosting his efforts to turn around the embattled chip maker. It was an update for the U.S. stock market today, with the S&P 500 index climbing by 0.1%, up 7 points. The Dow at a record up by 228 points today, up 0.5%. Dow Industrials now at 41,622. Nasdaq fell 92 points today, down 0.5%. The Nasdaq 100 index was down 0.5%. Traders gearing up for this week's Fed decision kept driving a rotation out of the tech mega caps that have powered the bull market in stocks. 10-year yield at 3.61%, with
So, Charlie, you were born on the first day of 1924. You have seen a century of history. Do you ever stop?
Not only that, I lived in the aftermath of a previous century of history. You could argue that about 90% of the progress of man has happened in civilization has occurred in the last 2 centuries. There was no car. There was no broadcasting. It was a very different world. We figured out so very, very much that was quite important as a start. And of course, that's what brought the economic system up, so man had enough leisure, had enough time to think. That's pretty much all of modern biology, modern medicine, and modern industrial civilization. Just imagine what the world would be like. It's extraordinary how resistant some people are to learning anything. Competency is a relative concept, and what a lot of us need, including the one speaking, is what I needed to get ahead was to compete against idiots, and luckily there's a large supply. And everybody wants fiscal virtue, but not quite yet. They're like that guy who felt that way about sex. He was willing to give it up, but not quite yet. Yeah, I think you would understand any presentation using the word EBITDA. If every time you saw that word, you just substituted the phrase bullshit earnings. I knew he'd do it sooner or later, folks. I like cryptocurrencies a lot less than you do. And so, to me, it's just dementia. And I think that people who are professional traders that go into trading cryptocurrencies, it's just disgusting. It's like somebody else is trading turds and you decide I can't be left out. But those of you who are about to enter business school or who are there, I recommend you learn to do it our way, but at least until you're out of school, you have to pretend to do it their way. In accounting, you can do things like they do They just throw away a few carloads, and then everything flows smoothly thereafter.
That happened in some unnamed international country.
Yeah, Italy. It's perfectly obvious, at least to me, that to say that derivative accounting in America is a sewer is an insult to sewage.
People don't seem to get that point. You have any idea why, Charlie?
Warren, if people weren't so often wrong, we wouldn't be so rich.
No, the inflation had bottomed. I'm saying they're a large, cautious institution that tends to move very deliberately. And so the Fed knowing what we don't know is less of a concern than, hey, when are these guys going to figure out what we've already figured out? I look at it differently than you.
Well, I agree with you on the Fed being cautious, and that's why we think they only cut by 25. Is first of all, the economy is slowing, but it's not on the precipice of a recession. Yeah, but on the second part of, I guess it has a little bit more to do with if the Fed sneezes or the rest of us catch a cold. So if they come in at this higher rate cut, it's not necessarily do they know a recession is coming. It's that if they're so concerned about it, should the rest of the world be concerned about it? You have an S&P that's trading around 5,600. Obviously, the S&P 500 is not concerned about a recession at this point. So that would be, I think, what would get people unnerved.
So my favorite question anytime we're talking about the Fed is not whether it's 25 or 50. What's the terminal rate? Where do they end up when everything is said and done?
I think that's the challenge. So first of all, this year, so in an election year, Fed tends to do more rather than less. So that's another reason I think they start slowly. You might get 1 or 2 more rate cuts by the end of this year. Then it just depends on, are we going to get that recession that we...
Today, I'm going to talk about how to succeed with a startup. Obviously, more than can be said here in 20 minutes, but I will do the best I can. The most important thing, the number one lesson we try to teach startups is that the degree to which you're successful approximates the degree to which you build a product that is so good, people spontaneously tell their friends about it. Startups always ask us for the secret to success. They always want to believe it's something other than this, because this is really hard to do. But this is it. If you can build a product that is so good, people spontaneously tell their friends about it, you have done 80% of the work that you need to be a really successful startup. If you think about the most successful companies you know, Google, Facebook, whatever, you probably found out about them because a friend of yours said, you got to try this, it's great. So this is the bar. Something that people love so much they tell their friends about it. One important indicator for a product like that is a product that's simple to explain and easy to understand. If you can't explain in a few words what you do, and if at least some people don't say, oh, that's pretty interesting, that's usually a mistake. It's usually a sign of unclear thinking or a need that is not big enough. Another thing that startups need to look for is a market that is either started to undergo or is soon going to undergo exponential growth. I think this is actually related to one of the biggest mistakes investors make when evaluating startups. Investors always say, well, what's your growth rate? We care about the growth rate. Investors will forgive smallish revenue today if it's growing quickly. For some reason, people don't think about markets this way. But if you think about the most important startups, they are the ones that I start in small markets that are growing very, very quickly. 11 years ago, the market for iPhone apps was $0. It's now huge. And I think if you only think about the TAM today, you'll make a big mistake. What you really want to do is identify a market that's going to grow every year and be able to ride that up elevator. A really important thing to figuring this out is learning how to differentiate between real trends and fake trends. A real trend is something that's actually going to happen and a fake trend is not, or at least not yet. And before you make a big bet on a new platform, you want to make sure it's real. Now, there's an easy trick for this, which I'll share now. Real trends are ones where a new technology platform comes along and the early adopters use it obsessively and tell their friends how much they love it. A fake trend is one where people may buy the product, but don't use it, or at least not enough. So an example of a real trend, I already mentioned the iPhone, I'll mention that again. When the iPhone first came out, many people were dismissive because they only sold 1 million or 2 million that year. And they said, well, this just doesn't matter. But for the people that had an iPhone, they used it for hours every day. It became central to their lives. They loved it. They told their friends, you got to get one. And I think it was obvious then to people paying attention that something had fundamentally shifted, and we had a new computing platform that was going to spawn huge businesses, and it was a good time to bet on mobile apps. A fake trend, or at least a fake trend as of August 2018, I would say is VR. I do believe VR will be big someday, but today most people that I know that own a VR headset use it never or very rarely. And so although a lot of people talk about it, and maybe even a lot of people buy them, there's not the intense usage per user among the early adopters that I think you want to see before you make a big bet. Another thing that startups need, at least one evangelical founder, usually the CEO. Someone at the startup has got to be the person that is going to recruit, sell the product, talk to the press, raise money. And this requires someone who can infect with enthusiasm the whole world about what the company is trying to do. And someone who becomes the chief evangelist for the company, it's very hard to succeed wildly without that. It's very hard to build a team at all without being able to do that.
Listening to Bloomberg Business Week with Carol Messer and Tim Stenevec on Bloomberg Radio and Television.
All right, everybody, we are back at Future Proof. Carol Masser along with Barry Ritholtz, and our next guest participating in a panel here at Future Proof about capturing the next generation of investors. It's something we've talked about. A theme, right?
Yes, absolutely.
Are you on?
No,
Okay.
There I am.
There
I'm
you
on.
are. That's
It's a
amazing.
theme because we've been talking to. There's so many young people here.
Totally.
So many young advisors. It's a place if you want to look into where this industry is going. We're better.
Right. Exactly.
And Betterment is one of the companies that has been looking into where this business is going.
We've got the CEO, Sarah Levy. How are you?
I'm doing well. Thank you for having me.
So what are you doing with the younger folks, and how do you get them, and how do you get them to come onto the platform?
So Betterment Advisor Solutions is really our RIA platform that helps this next generation of advisors reach the next generation of investors, right? And so, so one step removed, if you will. And what we offer is really a seamless platform to move between investing and cash and retirement. And I think the key to this generation, there's a lot that is the same with this generation as the prior generation, right? A long-term outlook. I want to be better off down the road than I am today. I want to pay low taxes. But what's different is their expectation of technology, right? Fundamentally, they have grown up in a world where everything from e-commerce to streaming is delightful and easy, and they expect the same of the platform they use for financial advice.
And I can access on my phone.
I can access on my phone whenever I want.
Right. So, latest use of technology, friction-free. What else are they looking for? Are they different than their parents in terms of what they want in terms of their portfolios?
I don't think they're different. We don't see them being different in terms of their portfolios. I mean, I think there's a lot of theory around how the 60-40 portfolio has evolved.
Because we've done stories about Gen Z kind of shunning the 60-40 and more interested in, investing in things like sneakers and, rather than stocks. So help us understand. Well, you say that they kind of have the same goals.
Well, I think ultimately their goals are to retire comfortably. And when you think about Social Security and the challenges that, they're unlike their predecessors, in the prior generations, they're not as comfortable with the role government is going to play, and they're fearful about what's going to happen to Social Security. They don't have the luxury of a pension, right, which their predecessors had. And so I think the idea that personal investing and a defined contribution plan is their future means they have to take more control. And I think what's challenging about taking more control is that there's tons of information out there, and there's disinformation, there's misinformation, right? So how do you make sense of it all, I think is the biggest struggle for them. And so they're seeking advice. And the ones who get great advice from advisors are the ones who are more confident that they will be able to retire comfortably.
Huh, really interesting. So technology, we've been talking about AI constantly this whole week. You guys have been embracing AI. Explain how you use AI to deliver a better product and better performance for your clients and their clients.
So I think of AI really as a continuum from automation. We've been delivering fantastic automation for advisors and for retail customers for a decade and a half. And AI really supercharges what we've been doing, right? There's a lot of fear around, which I think is unnecessary, around, is AI going to take over the jobs? And I think the better way to think about it is AI, people who don't understand AI, those are the ones whose jobs are going to be threatened, because you need to harness the power of AI to basically accelerate and supercharge everything the humans are doing. Right? And so whether that's paraplanning, whether that's marketing collateral, customer service, there are all sorts of ways where generative AI can basically strengthen the advisor's relationship with their customer by freeing up time and money, which is ultimately what they're after.
I mean, it's all about making things easier, right? And seamless.
Easier, faster, cheaper.
I am curious, too, in terms of the younger generation. I mean, are they feeling like it is going to be largely, you talked about 401ks, and that it's going to be the financial markets? Because I think I had a dad who had a pension and VA benefits and 401k and like just multiple things. And there's a generation that isn't going to have it. Is it going to be all about the markets, and they've got to figure this out?
Well, you're exactly right. And I think that is the fear that they have, right? Is that I'm not going to have the same kind of social safety net that my parents had. And so I'm going to need to fend for myself. And then to the sort of asset class question, they're wondering, also, some of them have a different set of beliefs or a social frame that they want to put around their investing. And so they want to make choices, whether that's at the margin or completely, about where is that money going, ultimately in service of a comfortable retirement.
So you'd mentioned there's not that different goal, but a different method to get there. If you're a 20-something or a 30-something, does a 60-40 really make sense? You have decades before you retire. How do you feel about the people who advocate just straight equity, no bonds?